Thank you. Please be seated. For the first 30 minutes, we will have Mr. Satyanarayanan Yanamantram with us. He will take us through the financial literacy and the wealth creation. He's from Krishna Capital, one of our event sponsor. Satyanarayan Yanamantram, a certified financial planner, did executive general management program from IIM Bengaluru. He also a MCom graduate and he did his MPhil from Chennai University. He is having 20 plus years of experience in international, domestic, public banking companies in operation, compliance, administration, and private banking. And presently, he is the partner of Sri Krishna Capital, mutual fund distributors from Chennai since 2009. May now request sir to come and occupy the dais. May now request Taxation sir, Chairman Direct Taxes Committee of SARCFICA, to present him with the shawl. Thank you, Satish sir. Over to Satyanarayan Yanamantram.
Good morning. Good morning. It's only 10 o'clock. Okay. Those who are interested, they can come forward. That's the first request. And I will talk about the financial literacy in the August gathering here. And thank you very much for the Institute and also for the MMA giving this opportunity to render whatever I know I wanted to say, what I learned in last 30 years, I will share it with you. And probably we conducted some 12 or 13 programs like this earlier. How many of you here feel that you don't have the financial literacy? Sorry to ask in a chartered accountant, area, financial literacy, personal finance, that's the main information. Or how many of you feel that today I can retire? Just I can retire, I can have the same lifestyle what I am having today. How many of you feel that we have? Everyone has or everyone is not having? So what I'm going to talk here, what India delivered in last, many decades or maybe centuries, we can say. India always gives. Always, we can say 3,000 years history or 2,000 years history, 1,000 years history. Many people came to India to take away something from India, whether it is a British or Portuguese or Greek or name it, people came here to take something from us. And for the last a few decades, maybe 40, 50, 60 decades, people are investing in India. Is it the purpose to take from India or to give something to India? To take only. So you can see FPI or FIIs or foreign promotional investors or foreign direct investors, everybody is getting into India to take something from us. What is there in India? We talk about population was a burden, maybe 1 decade or 2 decades before. But we proved that our population is the knowledge population and we will serve the world. Not only in US now, you can, everywhere it is demand, whether it is Italy or whether it is Spain or any country, name the country. Like before it was only, Canada and the US. Now, many people are going to German. German, they will not give that easily the visa. Now you see every next person, maybe if somebody is in Europe, maybe he will be in German or France because everyone to attract the talent. The reason being we invest in our future, our children. We don't invest something where, because we invest for children is the future. We invested in children. And childrens are the, I can say, the torch bearers for India. You agree or you don't agree? If you see 4 people, 1 family, children will be in US or UK or outside India. We are developing other countries also. Even we built temple in Abu Dhabi also. And recently, yesterday, I'm reading 20% more taxes, direct taxes collected. And when they said 38,000 crore for the GST in the first year collection, and they said it is only temporary, it will not happen in India. Many gatherings I was listening, most of them, they are negative because media is negative. We are not positive because, something will happen in India. And when it touched 80,000 crore, no, this month it will happen, it will not happen. Next month, 80,000 crore. And now we are marching towards maybe, 3 lakh crore in next 5 years. That's what personally I feel. Like 1,85,000 crore is happening consistently now. And it will happen 3 lakh because when we become $5-6 trillion economy, automatically things move on. Are we benefited personally? Personally means individually, are we getting the benefit? FIs are investing, taking the money out. And who is getting the benefit here? And the people will come and tell you, this is where you have to invest, buy a land, railway station will come, hospital will come, college will come. It will happen within 3 months, 6 months, it will happen. Whether it happened in the history, maybe some 10% happened, 90% not happened. People, I will come and tell you, I will give you 14% interest. Please invest in my company or invest in Indian market, invest in other markets and all. But how many percentage it happened? Historically, if you see, very minor percentages. And who are all the investors? Those who understand the product only, they will invest. Otherwise, people will come and go like a speculators. Speculators make money or speculators may not make money. And leverage is the destruction of the wealth. If we don't know how to leverage, it will become destruction. I attended a program in ISB. What they mentioned, less than 10 companies or 10 families exist in 160 years. In 160 years in Indian history, only 10 families exist in the business. Rest everything come and go. The reason being, we don't know how to leverage. And also the corporate governance, those who follow the corporate governance only win the race. Maybe if I don't follow the rule of the land, one day or other day I will disappear from the system. So we have to follow the rule of the land and we have to follow the regulations. Automatically growth will be there. I see many people, start, when I started the company, there is a ARN called AMFI registration number. That is means if I have the AMFI registration number, if my income is more than 20 lakh, I have to take a ARN in my wife name, or I have to take in the HUF name, or I have to take in my daughter name, son name, because I don't think that my income will not cross 5 into 21 crore. But that same time I told to my auditor, no, my dream is much bigger, not 20 lakhs and all. I will do in 10 years much bigger than that. So I had the only 1 year, I'm ready to register GST, ready to pay the GST also. So whatever the income I get, I pay 18%. But I made things are simple so that I can focus on the business, focus on the knowledge. Otherwise, people will be working on 5 accounts, 5 GST filing, 5 income tax filing. I suggest the people to reduce the compliance by reducing number of the companies within the family. And people feel how the elephant feels, I'm tied up with the nail and I can't do this. Same thing when it is coming to the capital market also, capital market is riskier. That is the mentally, we feel. I feel every single product is riskier and every product is subject to market risk. There is not a single product without market risk. Do you agree or don't agree? Every product, even if I invest in the education for my son or daughter, I don't know what is the outcome, whether they will qualify or they will not qualify, whether they will get employment or they will not get employment, whether they get 5 lakh or 50 lakhs, everything is uncertain. But still we invest on our children. Even if I go to the doctor, whether it will be cured or not cured, it is uncertain. Still, we try to get in somewhere without knowing the outcome. Outcome, we think that it is positive. Whenever it is coming to the capital market, most of us will feel we will not make money. Yes or no? Why we don't make money? I want the answer. Anyone can answer. Why we are not making from the capital markets? No patience. That is the only answer. Anything else? Always we want to be short term. What Warren Buffett says, people are urgency need of the money. They want to see the growth in 3 months, 3 years. It is not happening. People are not ready to become rich slowly. That is a mantra what he says, I'm rich because, at the age of 60, I had a billion and today I have maybe 70, 80 billion. 60 to 90, 30 years. But most of the rich people you can see, it happened after 50 only. Because they try to learn from 20 to 50. 30 years they invested to learn. But somebody can learn at the age of 20 and it is the Varaprasadam. Jalapinda Nipedana Kramashaka Puriyate Gataha, Tatahi Sarva Vidyanam, Dharmascha, Janascha, Karmascha. If whatever it is, if you see, karma, dhana, and also the vidya, it happens kalakramena bhavati. It happens its own time. I can't say that I learned today or I will do the good karma for 10 days. I will expect lifetime good things. Same thing, wealth creation also. Always is a disciplined way we have to move on. Then only the wealth creation happens. Otherwise, when I can retire with some 10 crore or 20 crore, I feel every chartered accountant at the age of 25 today can retire with 100 crores. That is what India gives. This, all are rich people here. They died poor. All are, they made the fortunes. Savitri was getting one of the movie, more than Shivaji Ganeshan, but she died pauper. Chinnappa Devar, I can give the n number of names, people, A.K. Hangal, the Sholay, the person who took the Sholay film, he was trapped under debt trap. Somebody has to come and save him. So, but how to manage our personal finances? They did have the advices. They did have many people. When the chartered accountant at the age of 25, average salary is today 8 lakh rupee. You agree or not? The freshers who is coming average, you will get 8 lakh rupee. Even if somebody saves 1 lakh per annum, last 25 years, 1 lakh saved is, I will give you the numbers there. They can retire with at least 100 crore. But always I believe, live rich and retire rich. Don't retire rich, which is waste. We have to live rich and retire rich. And here, very, very important, how many of you insured here? All are insured? Health insurance and medical life insurance, all are insured? Yes or no? How many of you are having your insurance coverage 20 times of your annual income? 10% or 5%? If my annual income is 10 lakh, I should insure for 2 crore. Assume anything happens to me, my wife will get 2 crore and she will get 5, 6, 7%, 14 lakh she will get. But if I insure only for 10 lakh rupee, maybe one year everything will be vanished, that expenses. So insurance is compulsory. There is no options at all. Ensure that you are insured minimally of 20 or 30 times of your expenses at least. At least whatever your annual expenses, insure for 30 times. Then only you are insured. Maybe you bought a car for 20 lakh rupee. If you are insuring for 2 lakh, there is no use of that car insurance. So please ensure, maybe 5-10% may be insured. So financial literacy starts from the security need. It is must, maybe from tomorrow you go and 100% you have to insure if you feel insurance is required. I have already 50 crore. I don't want 1 crore insurance, then that is different. Again, the health insurance, that is also compulsory. Because all our practitioners mostly, maybe your company may not pay you. If you are practicing on your own, maybe you have to insure for minimally 5 lakh or 10 lakh, whatever you need personally, that you have to have. If you don't have these two things, assume you have 50 lakh rupee. If something happens, you have to pay 5 lakh rupee to the doctor. 10% of your wealth is vanished. Ensure that you have the, because investment is option. What I'm going to talk here is option to live rich and retire rich. That's it. All these are all the dreams everybody. When I can buy a BMW, everybody can buy. That's what I will tell you. If I can buy something X, everybody can do. I studied from Corporation of Chennai. I lost my dad at the age of 4. Even I went to IIM. If it is possible for me, everybody can do this. That is a mantra I will tell. Everybody can have whatever their dream, but only towards we have to focus on the dream and get in there. Then only we will achieve. Maybe I will invest today. I invest for 10 years, but after 10 minutes, I want to see the share price. My objective is long-term 10 years, but I invested today, but after 15 minutes, I will see what is the share price. That is where the problem happens. And education and medical expenses, please ensure you have the proper objective for your children and yourself. Otherwise, it will become, your wealth will be eroded. You will not have the retirement corpus. And you are aware of that. Actually, we had that, Araprasadam, actually, I will say, indexation of the bond funds. Now it is removed. Even existence of the whole structure may be there after 5 years. I don't know. Maybe even the new tax plan comes, everything will be only history. And Warren Buffett says here, by deferring the taxes, I'm becoming richer. Suppose if I put the deposit of 1 crore in bank FD, I will get 6 lakh rupee, I pay 2 lakh taxes. If I put the same money in bond fund, maybe banking and PSU fund, I may get 5% or 7%, but I will pay the taxes when I sell only. So I'm deferring the taxes maybe for next 20, 30 years, I will not pay taxes. Like buying a land and buying a apartment. Apartment, I get rental income, I pay taxes. But if I buy a land, I defer the taxes, so wealth is created. And change is constant. Out of 30 companies, only 4 exist in Dow Jones. Same thing in India also. Nothing is permanent. As I told you, hardly less than 10 families exist in India in last 160 years of the Indian business. So change is constant. We have to move on. And we have to adopt the digital also. If we don't adopt the digital, and we will be away from our own map. And if you avoid the way, assume people, they don't want to save. Even by avoiding the wastages, people can become a crorepati. Avoiding just the wastages. You think last 30 years or 20 years, how many things what we wasted? Here advertisement in my street, they put Audi offer. It is a saloon. And they put now Christmas offer. And they put Diwali offer. And Byju's back, tuitions are back from 4th standard to 10th standard. Tuitions means those days, tuition povaradhukku. Inniki public porom. Today openly we are going for the tuitions. If I don't send my child to tuitions, maybe undermine. Before, if you want to go to tuitions, chupke jana hai. We can't go because the tuition person is going to tuition means he is mediocre person. And the same thing, Dulha Dulhan course. Out to what is marriage, what is wedding. There is a course is there. Before family will tell, father, grandfather will tell. Now there is a course. How to speak to husband, how to speak to wife. All these things, it is run by the MBAs. And you can see the Adagakada. It is a Krishna Adagakada. I will give you, if you take a 40,000 rupees loan, I will give you 1 liter. Be away from all these things. And we love the combo offer. We love the combo offer. Anything, maybe I want to go for loo. Only for urine, I want to pass something, 5 rupees you pay, you can do both. We are ready to that. Even I want to take only idli, but I will take the combo flat. Maybe I will drop 50% of that plate and come out. But by avoiding the wastages, definitely we can become the crorepatis. In Reserve Bank of India, I address the youngsters there. I will tell them, whether are you changing your telephone every 2-3 years? They will say, I will change every 6 months. Every 6 months, they are changing the telephone because they are 25, 26 average age. Because people are not ready when they are 25, 26. Maybe Marwadis and Gujarat, they are ready to listen, even at 10 o'clock in the night when I give a lecture. But otherwise, common people, it is investment is last resource. So I show this slide to them. If you save like 80,000 rupees, if you don't buy telephone for 4 years, that 80,000 in 4 years will become 4 lakh. After that, don't save anything. What you wasted for 4 years, telephone will become 3 crore. If that is one thing, you imagine how much we wasted. Even myself personally, I will admit, I wasted my 60% of my income in Gulf only for flight charges and telephone charges. 60%. It is not a small money. I was thinking I'm enjoying. Even I don't know, if I invest this much, I will get. And 1 out of 5 land records, or lands are in deep trouble. Not that, everything is safe. So before you sign up anything, please see everything is in order. Otherwise, we will end up in trouble. Bharat badal raha hai, which is very good. And the journey is not a straight line. I took only from 93 to 2024 now. The journey is not a straight line. But if you see gold and also the Sensex, it looks like it performed the same. Maybe Sensex performed 10.7%, gold performed 9.6%. But if you see the actual active funds from 93, 95 versus today, which delivered 100 times return, most of the active funds, even if it has average active funds delivered more than 100 times. But whereas Anna Nagar could be 30 lakh become maybe 5, 6 crore, 20 times. I'm talking land. Apartment maybe 7 or 8 times. Somebody bought in Tambaram for 5 lakh rupee at 500 rupees per square feet. Today, if they sell, they may get 5,000 rupees, hardly 10 times less rental yield, which is nothing. I bought a property in T Nagar for 5,50,000 in 94. I came back to India. I want to sell. They said, I will give only 5 lakh. So 10 years, zero return. It is a negative return. But same thing last 12 years. Somebody bought from T Nagar for 5, 6 crore. Today also same 5, 6 crore. Apartment maybe 15, 16,000 rupees 10 years before, could be today you will get 12,000 rupees, which is negative return. But will that happen in future? We don't know. If you see 30 years track record, apartment delivered 9% return. If you add 3% rental yield, if you don't have much less than that, across India I'm talking, not only Chennai, Bombay or Calcutta, everywhere it delivered less than 10%, provided if the tenant stayed there for 12 months. Any area, whether it is Baliganj in Calcutta or Churchgate in Delhi, Bombay, anywhere, it's the same story. But land delivered more. Somebody bought in T Nagar, maybe made 15 or 20x. Somebody bought from Perungudi or Vogapur, they made 40 or 50 times or 100 times. And we don't make money because of this. In the capital market, we don't make money. My favorite slide, this is very, very favorite video, short video. What is it? You are doing, I'm also doing. My neighbor is doing, I'm doing. My friend is doing, I'm doing. But I don't do what I wanted to do. I am investing in the capital market thinking that I want to get at least 5-10 crore at the age of 60 or at the age of 55. But automatically my neighbor is doing, he's selling land and buying capital market, I will do that. If he sells shares, buy a land, I will do the same thing. That is the reason we don't create the wealth. And the future war cannot be, on bullets or something. It is on the cyber war. It may be, biological war. It cannot be, one-to-one on the face. It will happen in an indirect way. Our assets are safe only if our country is strong. Assume somebody in Libya, somebody in Yemen, Sudan. You name the country. Even in Kashmir, what happened 30 years before? Everyone lost everything. Maybe in Wayanad, we don't know. But many things happen in Wayanad also. But when it happens in our street only, we will come to know, we have to be very strong. We have to be very safe. Otherwise, you may have 4, 5 houses or you may have 100 crore. Nothing is useful if your country is not strong. And China become 5 years, it doubled its GDP. US doubled in 10 years. Japan doubled in 8 years. And I feel we will double in next 8 years. Personally, I feel in next, whatever we are GDP today, in next 8 years, we will double. That's what personally I feel. Because that aggression from the youngsters, aggression from the Marwadis and Gujaratis much higher than South Indians. That's what my personal feeling. We are not aggressive in what we are doing. And even India remains the youngest population. That is the biggest catch for us, which is the biggest advantage also. And again, if you see, income levels are also increasing. Maybe 6,000, 5,000 was a dream in 1993 for a chartered accountant. Salary, annual income of 70,000. Today is 8 lakh rupee. If you compare 70,000 versus 8 lakh in 30 years, it's not a small, it is a very good. At the same time, expenses are also going up. But we will do much better than that. Maybe we'll start to charge on hourly basis. That will happen anytime. All quality players already started that. If I work with you for 10 hours, you have to pay me this much. Quality player, those who are answering the telephone. But most of us, we don't answer the phone. Yes or no? Answer panna, நம்ம வந்து ரொம்ப பிஸியா இருக்க இல்லன்னு நினைச்சுப்பாங்க. If answer பண்ணாதான் நினைப்பாங்க. First, I try to, if I don't answer in 4 rings, my customer will disconnect the telephone. Even the person I'm managing 30 crores, I'm busy, I will call him back. So my request to everyone, I came here to talk about the financial literacy, but for our profession, I will tell you, we have to answer the phone. At least we should have the guts to say, don't call me. And market capitalization, where India was 1 trillion in 13, today we are 4 trillion. And where America in 2013-22, China was 3.4, today it is 9, 3 times. And becoming doubling is difficult or easier? It is very easier, but only we have to visualize. But assume wherever 20% or 30% still people are not paying the GST. You can get, I went to one silver shop. I want to buy the silver for my daughter's wedding. I asked him GST bill. I have to wait for 40 minutes. He is not ready to give the GST bill. So that situation should change. It will change only if we follow that changes. If that happens, that 10 trillion is imaginary. It will happen. Automatically it will happen. If that happens, if everybody pays the GST for every bill or GST bill, automatically 10 trillion is possible. And demat accounts from 4 crore to 12 crore. But how many people make money? That is very important. This we aware of it. And there is no shortcut actually. And again, this is very, people who are investing in the capital market, thinking immediately, I want to reach the goal maybe in 6 months or 6 years or 1 year. But it never happens. Maybe gold 3,000 rupees to 6,000 rupees, 6 years. No return, 3,000 to 3,000. 2012 to 2018, no return, still I will hold the gold. Last 10 years, 0 return from the real estate, I will hold. Whenever we come to capital market, we want immediate return. That is where the problem. And how many times Sensex corrected more than 20 times in last 25 years? Hardly 7 times. Hardly 7 times it corrected more than 20%. Still we are worried. But if I assume Velachery 1 month before, if I want to sell that flood happened day, I can't sell even for 50%. Yes or no? Vesan Nagar, 2004 tsunami happened. That time it was 30 lakh rupee per ground. People are not ready to buy even for 5 lakh rupee. But flood will come to the capital market. Any news comes, flood will come. Any news comes, earthquake will come. Just we have to ignore and stay invested in the quality product to gain the investments. And somebody invested at the peak, they made 12%. Somebody invested at the lowest, they made 14% in last 29 years. Even somebody investing in the peak, they made money. Every year peak only people are buying. Somebody buying disciplined, systematic investment, 13% they made, which is an exceptional return. I'm talking about the index. Active funds delivered more than 18%. Rakesh Junjunwala, 200 crore become 400 crore. 93 versus 2022. 200 become 40,000 crore. 200 times. Even there are mutual funds 100 times, 150 times, 250 times. Nippon Grow. Whatever the scheme I'm mentioning, not for sale or something, no recommendation, just only education purpose. Reliance Growth Fund today, it is a Nippon Growth Fund. NAV is 290 times, which is not a small. It is only 200 times there. %50 in property, public provident fund, and also insurance, all put together will come to 80% of the household saving. Hardly 4-5% in equity. Every single rich person only in the capital market. Yes or no? But we know that we are not investor. We are all traders. And this is the latest information. Those who are holding more than 5 years in mutual fund. Somebody invested in mutual fund. How many people are holding more than 5 years? You can see the number, 2%. Exited in 1 year, 50%. I invest, if I don't get the money, I will exit. We don't make money at all. I have to hold it for, you can show me a scheme which lost money by holding 7 years. I did not see a single diversified equity scheme. I lost money or lost the money in that particular scheme. I said, kuch scheme nahi hai. No scheme like that. Every scheme delivered positive return if you are holding for 7 years. But people feel mutual fund subject to market risk. Everything is market risk. And this is somebody invested in Sundaram mid cap. I will just go to the mid cap, last line. In 2002, they floated. NFO came. That time 10 rupee. In 2009, it was like, 60 rupees, 113 rupees, 2009. 11 times, 1 lakh become 11 lakh. Today, what is the value that? Because Sundaram, because South India, we know, Sundaram, everybody bought Sundaram mid cap. Yes or no? I can say 60-70% people bought Sundaram mid cap. But how many people are holding today, which is 100 times? 10 lakh become 10 crore. But are we holding 10 lakh? We bought a Krompet apartment or maybe Tambaram apartment 25 years before, 20 years before. But we don't hold this. But I will hold that apartment. This is the what I will share this to you. What is there today? And even somebody invested in the tax saver. Last 25 years, instead of putting money in insurance company, 1 lakh invested 25 years, 25 lakh, how much we get? 50 lakhs we get, correct? I will get the double the money. If I put in public provident fund, I will get triple, 75 lakhs I get. If somebody invested in ELSS, which is 4 crores today, again, 20% fall, it will become 3 crores, still much higher than any other asset class. But are we holding it? That is a number. And this is the favorite slide I will show you. Start early, but even elderly or people are also there. Maybe you can encourage your children, but I want elder to enjoy. Maybe whatever we lost, we have to enjoy. Youngsters, I will tell you, save something. Otherwise, whatever you are going to waste, save that one. But somebody started at 25 lakh, which is 30 crores. I told my daughter, I kept some money for you. Don't need to think of retirement. Enjoy. Do something good for the society and for yourself. That's what I told my daughter. Because your retirement is already taken care of. This 30-40 lakhs will become at least some X amount. Whether India will give 15%, this is imaginary. Whatever is shown the earlier slide, which delivered 18 or 20%, which is fact. But this 15% is imaginary. Whether I get 15 or 12 or 18, I don't know. What is tomorrow? I don't know. What is flood will come? I don't know. That is the situation. But TV people will come and tell you morning buy, evening sell. And this is the lovely, I love this actually at the age of 25, invest only for 10 years. I did this. Only invest 10 years, after that don't invest at all. Assume 5 lakhs investment in PPF, FD, gold and mutual fund equity. The 5 lakh after 10 years will become 96, that will become 20 crores. I'm not investing for 25 years. I invested only 20 years, waiting for 25 years. Later, I will get, at the age of 60, I will have this much. By saving only 5 lakh per annum. So youngsters, I strongly promote this. So that, no need to keep on save. Enjoy your life. Economy will be very good. We will achieve that 10 trillion. If I don't spend, our economy will not become 10 trillion. I have to spend. Like America is a consumption economy. They consume. That is the reason they are 20 trillion. We were like this. We became like this. And we are like this now. But still we are running. Why we are running, we don't know. Without enjoying. Maybe morning from 9 o'clock to 8 o'clock, we are working in the firm. I've seen many people. Is it necessary? We have to enjoy. We have to see Australians to enjoy. They resign the job and they go and enjoy. I'm talking the Australians, they will not work. Maybe after save for 1 year, they resign the job and they will enjoy. Life is beautiful. We have to enjoy. And I give some few papers, what I've shown you. Those who are interested, they can collect it from the reception desk. And need a trusted person. Everyone needs a trusted person. We need a good doctor. We need a good chartered accountant. We need a good investment advisor. Whatever it is actually, we need always good. For that, I have to be very good first. It is a recent Delhi advertisement, timed out. If the helmet is not good, what will happen for a life? So we should have the very good helmet. Thank you very much. Hope I completed on time.
Thank you very much, N. Mantram, sir, for emphasizing the importance of financial literacy and wealth creation. May I now request I am Palayam Venkateshan Arun, Secretary SCRC of ICA, to present him with the health bouquet. Thank you. Thank you. We are quickly moving to the first technical session, issues in SME taxation. We have with us CA Ramnath from Coimbatore. May I now request Chairman SARC, Panara Sirigiri sir, to escort CA Ramnath sir to the dais, please. May I now request the Regional Council member, CA Narichandra Gilli sir, to formally introduce Ramnath sir.
Good morning to all the delegates who are registered for this program. It gives me great pleasure in introducing CAV Ramnath. He is a BCom graduate and fellow member of the Institute of Chartered Accountants of India. He underwent his graduation in Government Arts College, Coimbatore, Tamil Nadu during the year 1990 to 93. He pursued his chartered accountancy during the year 93 to 96 under CA K.S. Palaniswamy, Chartered Accountants from Coimbatore. He cleared his intermediate exam by obtaining 33rd rank on All India basis and 43rd rank in CA final on All India basis. And he was also a gold medalist at the Coimbatore branch in CA level. So presently he is partner of firm Messrs. K.S. Palaniswamy and Company, Chartered Accountants, Coimbatore. He has put in around 27 years of experience in handling audits of various corporates, non-corporate entities, and has also handled appeals under Income Tax Act up to Income Tax Appellate Tribunal. He handles corporate and non-corporate restructuring cases. He was a faculty for the CA final direct tax paper at Coimbatore for 17 years. He has presented papers in direct taxes in seminars, conferences organized by various branches of ICI. He has also addressed the students of various colleges on the topic relating to commerce and taxation. He is also a member in the Academic and Governing Council of various education institutions at Coimbatore, Tamil Nadu. He was co-opted member of Direct Tax Committee of the Direct Tax Committee at ICI New Delhi and a co-opted member of Direct Tax and International Committee at SRC. With this brief profile, I introduce CA V. Ramnath, and I request all of you to welcome him with a good round of applause.
Thank you, Gilli sir. May I now request the Chairman SARC, CA Panara Sirigiri sir, to present Ramnath sir with a soul. Requesting Regional Council member Rekha Umashiv to present Ramnath sir with a health bouquet. Thank you, Panara sir. Thank you, Rekha ma'am. May I now request Ramnath sir to take us through issues in SME taxation. Over to Ramnath sir.
Chairman of SARC, other office bearers, and good friends of mine. Happy to be amongst you this morning. Lovely occasion to meet many friends after a long gap. The topic chosen is code program as such is very good, coined very nicely. And no crisscross. Though topic is direct tax, thankfully the topics are not crisscrossed. One is exclusively one can handle. For me, it is issues for SMEs. I would call it SMPs. It is our issue now. It is not SSC's issue. For others, at least, there is slight demarcation between assessee and counsel, assessee and professional. For these cases all, it is not their issue, it's our issue, and that's where our members step too much in seeing the solution comes for those SSEs. In many occasions, our members go one step forward to treat as it's our problem. And many of the occasions we land into difficulty without drawing the line or Lakshman Rekha. Many of my sessions have been mentioning that no doctor does this, no lawyer does this, but our professional believe as if it's the problem of us. Somehow we should ensure that SSE doesn't land into difficulty in spite of all mistakes he has committed. In spite of all mistakes he has committed, we must see that he gets bailed out. Many occasions our people believe that our talent remains in bailing him out. If we don't bail him out, it's as if we are not competent, and somehow we should ensure that he gets out. But he must have done it all, whatever otherwise he should not have done. But nevertheless, we call it as if it's our success lies on this. That's how we started working, and we crossed the Lakshman Rekha. And that is where we will have to be little more careful. We'll have to draw the line and see that it doesn't happen, so that we'll have peaceful life. At the end of the day, as our immediate speaker said, life has got so many good things, but our profession is one where we spend more time for others, not for us, our family, our friends, etc. I always used to see the statistics coming from government on the last day. Deadlines are over. Next morning, they'll say this many number of GST returns filed, this many numbers of income tax returns filed. The deadline, last 6 hours or 4 hours, you see, highest number of returns would have been filed. 8 o'clock to 12 o'clock or 7 o'clock to 12 o'clock. So that means we are not having any personal life, timing, etc. Our office should work 24/7, and last 4 hours, etc. only we will have to show all that and achieve the deadline. And the others are there to enjoy, and it's for our curse we will have to do it. One of the occasions where I always used to say this to our friends, don't do this, but still at the cost of repetition, I'm saying, a search related case, December 31st, we have to complete the assessment. My friend was working in the same corridor. He was working for one case. I was working for another case. We were discussing and representing facts to the assessing officer. The officer said to other friend of mine, on this point, I thought I can better have a word with client, assessing. But my friend who is representing said, sorry, it's not possible. No, this is one where evidence is there. I would like to have a word with him before we conclude. No, we will conclude. Why do you say so? Sir, I am working here till every day night 11 o'clock, sitting in the corridors of income tax department, etc. But the client said, do whatever you want. December 25th, Christmas, December 31st, New Year celebration. We all travel to New York to celebrate it. Whose case this particular friend is working for? But he is celebrating in New York. Along with my son and daughter-in-law, we are all going there, enjoying it. You can continue with search assessment. For whose sake, up to 12 o'clock and 1 o'clock, every 29th, 30th, 31st, he has to work. This is what is happening in our profession. We'll have to draw the Lakshman Rekha clearly and proceed. This is what I personally feel to start with. Now, it is not SME taxation related, it is SMP related taxation. With this prelude, we will get into this. Of course, charity has become a topic by itself. Number of hours we can discuss, and every budget last 3-4 years added good amount of fuel to fire. We'll take 3-4 practical aspects on it as to how to overcome, right? So it's a case where in the recent past, we have seen these cases, therefore I pulled out. It's a case where the SC furnished return of income, gross receipt 1.5 crores, revenue application 1.1 crore, capital application 0.2. Now, having filed the return, a proposal has come from CPC saying your gross receipt is less than 5 crore. You ought to have furnished audit report in form number 10BB, but you have filed form number 10B. The audit office consistently followed. form number 10B, previous year 12A, 10B, this year also 10B they have followed. It should have been 10BB because this year onwards 10BB is less than 5 crore, above 5 crore 10B. Form was not properly chosen. Therefore, system says you ought to have filed form 10BB, you have not filed 10BB. Therefore, one of the conditions of 12 capital A subsection 1 clause BB are not followed. Now what happens? Your application is not considered. For the gross receipt, income is sought to be worked out. So in the entire application, 1.3 crore and also 11.1 small a, another 20 lakhs, everything is going. Now in this scenario, what to do? So all of us will have these sort of difficulties. First is 10BB contains lesser information, 10B contains more information. So technically we have followed more than what is necessary we have given. But given what you have asked also for that particular case we have given. So we have complied with the concerned law more than what is necessary. But CPC does not understand this. It's a machine reading language. Whatever we say, difficult in making the system understand it. So we can give this 10BB. Technically, by filing 10B, we have filed 10BB. Therefore, it has to be treated as compliance. But whatever we say, 143(1) will come, making definitely an intimation liable for payment of taxes. Now, let us file 10B. Instead of 10B, we'll file 10BB now. Add CA. And then again upload 10BB. Now, there is a delay. Ask for a reprocessing. It will again result in same thing because there is a delay in filing 10BB. Let us go for condemnation of delay. Reason, genuine reason from 10B to 10BB intervening period, and this is only a first year, therefore we can make a petition. That's one way of getting out. Now, another aspect is, if the numbers are not this big, if revenue itself 1.45 crore, revenue application itself is 1.45 crore, then what remains is only 5 lakh. Slab rate applies, just to 2.5 lakh will go. Balance 2.5 lakh is only 5%. Section 1310 came applicable from the assessment year 23-24 to say, in case 12AB subsection 1, 12A subsection 1 clause A, KB, etc. are not followed, revenue application excluding depreciation shall be allowed. So to the extent of revenue application made out of income on revenue account without depreciation and subject to 40A3 and 40A1A shall be allowed. So if the numbers are not resulting in great tax numbers, then at least instead of going for condemnation, etc., slab rate on the balance income from this year, it is going to be a bonanza. At least to that extent, these cases, there is no great worry for that matter. So at least section 1310 can be looked into. So that's one aspect one can plan for. Next is an educational institution. It has got gross receipt 1.75 crore and net income 0.45 crore. It has got 12A registration valid. In that, while filling up columns, in spite of 12A registration, they have gone under 1023C class 3AD. There is a table which says what's the gross receipt, what's the expenditure, what's the income. Then when it comes to mainstream computation, how much is the income claimed exempt? So 0.45 lakhs is the net income. So put 0.45 lakhs. Now CPC says your gross receipt under 1023C is 1.75 crore. But you say in your return only 0.5 crore is what you are claiming as exemption under 1023C. According to CPC, entire gross receipt you should have put there. You put only 0.45. 1.75 gross receipt, 0.45 you claimed as exempt. Balance we are going to tax. It's the proposal coming from CPC. How on earth we will understand CPC will treat entire gross receipt income for the purpose of 1023C class 3AD? Something which we would not have dreamt. How CPC will read this? So now notice come. If the notice had come prior to December 31st, we could have filed a revised return, altering this number so that the nuisance value could be avoided. The notice had come only after December 31st, revision is not possible. So now, again, we'll have to write a note saying we are treated income as net income. Honestly, such type of interpretation is not appropriate. If 1023C is not allowing them exemption, what's the amount on which tax is required to be paid? The income. Income which is claimed exempt, if at all not exempt, the income is to be chargeable. That means in this case, it's not 1.75 crore, it is only 0.45 lakhs. But CPC treats the entire 1.75 crore should have been mentioned in the column claimed exemption, failing which the difference is sought to be added as income. Now again, this has to be written, but of course, in my personal view, how much ever you write, that may not go good. And we will have to end up in saying CPC read this class wrongly. Only in appeal, one will be able to get a read. The technical, again, we have one Income Tax Act and one CPC Act. All right. Legally, 154 is possible. Before CPC, it is not possible. Because CPC has got one rule. After they process 143(1), any 154, income should not come down. If income need not come down, why should there be 154? On tax number, TDS related, self-assessment tax not considered. Only for that 154 possible. Other things, 154 not possible is what CPC thinks. The rule of CPC is drafted that way. I personally feel law nowhere says 154 should be restricted to this particular level. 154 is possible. We have good number of judgments to say one mistake apparent from record. It's a clear-cut mistake. Columns wrongly filled up. We can alter and do it. 154 now in a technical form. How will we communicate this? We'll have to file a rectification return. Moment we file a rectification return, the system will say income gets reduced in a rectified return. We will not consider. That is another way where Uttam sir will take good amount of time in litigating on it. Of course, now I leave it to you. If you have wherewithal to do it, do it. But my personal feel is at the end of the day, assessee should see demand should get out, right? So obviously there, one way we can file, see wherever we have lost the time to file an appeal, we'll make 154. Let them dismiss it. From that day, within 30 days, file an appeal. At least we have a case. Of course, more about it in the second half, we are going to anyway discuss. Let us not get into that aspect. Mr. Kapil will anyway handle those matters well. Now, this is another educational institution. It has claimed 1023C3AD. For an earlier year, the assessing officer said, your object class has got more object than running education alone. He had dreamt what Supreme Court would say in New Noble. And he has disallowed the claim. Quite unfortunate to the SAC, CIT confirmed it in appeal proceeding. By the time the matter is before CIT appeal, New Noble decision came. So therefore, CIT says, Supreme Court also says, if you are going under 1023C3AD, it is not engaged only this. It is, you will have to see that your object class contains only this. If you have more than that, you are not exclusively doing this. Your object permits it, and therefore will not do it. The last few paragraphs of New Noble gives a good amount of time for the SSC to alter the objects. Supreme Court says New Noble should be applied prospectively. And they gave time to see that you align your object to give effect. How it can apply for Asterius? Supreme Court itself says apply prospectively, give time to SC to remove all the objects. If that be the scenario, obviously that should not affect the Asterius. So the very same New Noble we should follow and say in the last few paragraphs it is made clear and therefore it should not affect the Asterius. But better course to see that prospectively you delete other objects and give that you are not intended as well as you are not permitted to do, so that you have a better case at least before tribunal. There's another scenario where, say, runs a school and he has got transport. Also, he has got some academy to train people occasionally. Now, transport, the SSC would like to concessionally handle for the students. Therefore, transport division runs at loss. Many of the occasion, transport divisions are run at a loss. Also, this vocational training also runs at a loss. Now, interestingly, in the course of the assessment proceeding, the assessing officer takes a view. 11.4 capital A says income from an incidental business held by a trust would also qualify for exemption, subject to other conditions being satisfied. Books are separately maintained, applied for 85% for charitable purpose, etc. So, trust has main object. Income from property held under trust will qualify for exemption subject to satisfaction of the conditions specified in that section. 11.4a talks about incidental businesses. Income from incidental business will qualify for exemption if this is applied for charitable purpose subject to all other conditions being satisfied. So it's a one-way traffic. Now, we are incurring losses in incidental businesses. Income of charitable trust is applied for funding this loss. Now, what did you do with income? You are not applying for charitable purpose. You are incurring losses in a business. To fund that loss of the business, you are using the charitable trust money. So to that extent, when you are funding the losses of the charity, this is not qualifying for 80% application. Income from incidental business would qualify for exemption if it is applied for charitable purposes, not reverse. This is what the process of the assessing officer. Therefore, he says, losses being funded from your main activity, that will not qualify for application of income. Very dangerous way things are getting unfolded, right? So now, what happened in incidental business? Usually, we will have three types of businesses coming within the trust's fold. One is a case where the activity is not anyway connected with the achieving of objects, but the income from that activity is utilized for achieving the objects. That's a business where the business feeds charity, but not connected with charity. Another type of business where by carrying on that business, incidentally, the assessee would try to achieve charity. I'm having my regular activity. I'll carry on certain business activities which will be incidental to achieve my charity. The third one, I'll do business. By doing that business, I'll achieve charity. Doing that business itself is claimed to be charity. So now, let us take a case where a charity is doing good job of taking care of children, an orphanage or an old age home. A philanthropic person says, I'm running this garment business. You are doing job very nicely. I'll give my business to you. Income from this, use it for your charity. Garment business and taking care of old age people, no way connected. But income from this is going to feed charity, first category. Unconnected to object, but used for charity. A school running stores, running canteen, running hostel, running transport, incidental businesses feeding charity, right? Hospital, having pharmacy, incidental business. Having canteen, incidental business. Hospital by itself, if a limited company does this activity, that hospital by itself is a business. So now, incidental businesses, when I subsidize the cost of these incidental businesses, business incidental to achieve object, why should I incur loss? I am subsidizing the price of that particular activity. By doing that activity only, I am going to achieve the object. When I am running transport at a concessional rate, the school activities get furthered. Otherwise, I will inflate the fees here, elsewhere I have to charge. So, by running transport or occasional training institute at a concessional rate, imparting education is my main object. That is what is sought to be achieved. When an incidental business incurs losses, and that is funded by main activity, again, I'm only going to achieve the object. The fund is utilized only for the purpose of achieving the object. Therefore, that would qualify for deduction. Not a problem. But the problem would come when it is not incidental business, unrelated business, earlier making profit, used for charity, subsequently, sometime later, if it starts incurring losses, and to fund that loss if monies are paid. There, why should you incur losses and use the trust money? That question may come. If it is incidental business, it's only furthering of the objects of the trust, and therefore there would not be any difficulty. And next is something with reference to computation of income from house property. You please let me know when we should have to break for our tea. Whatever time, accordingly I'll plan. Okay, now, fine, sir. Good. So first, relating to computation of income from house property. Certain fundamental aspects which will start building further. Municipal taxes paid. That's one head of income where mercantile and cash concept would not apply. Whatever a statute says, we will have to follow. And statute says differently in different occasions, right? For a municipal tax, the section says only when it is actually paid, irrespective of the year for which it belongs to, year in which it is paid will qualify. Okay, municipal tax component we sometimes would have penalization also. Government thought that when the people make mistake, we'll make that as a source of revenue. Earlier, when people construct residential units or commercial units with the deviation, one-time penalty used to be there. Sometime later, wisdom prevailed to say every year you pay penalty. And that made people to violate the law. Anyway, going to pay penalty, will collect money from the tenant and will keep paying, will violate the law. So it gets legalized subsequently. So now every year, half-yearly payment, we'll have also, in addition to the regular municipal tax, also the penalty component embedded in the payment. Whether the penalty paid would qualify for municipal tax deduction under 24 and 23, computation of annual value. Language of the law is not very clearly prohibiting or permitting, but of course, in a different context, we have a Bangalore bench of the ITIT to say, going by the scheme of the law, this is not permissible. So only the principal municipal tax would qualify. The penalty component will not qualify for benefit. Now we have one practical scenario where when the revision took place on municipal tax payable, 10 times they've increased. From last year to current year, 10 times they've increased. The tenant was a retired major in an army. Very obedient, law obedient SAC. So he paid the 10 times municipal tax and filed a case in the court. 10 times revision is not correct. He paid and filed. Against rental income, this particular 10 times was claimed as deduction because we are not sure what would happen in future. Subsequently, in the court, when discussions went on, the department said it's a typographical error. Instead of 2 times, we typed it 10 times. He has succeeded, got 8 times of the money paid after last time, whatever he paid, 8 times of it, he got refund. Question arises to the taxability of the refund received. Whether it is taxable or not. This gentleman said, I will not pay tax. It has come in the bank and scrutiny. At that time, scrutiny took up that bank statement was verified. What is this? Refund of last year, what I've paid. That is not chargeable. Officer said, you claimed deduction 10 times last year against your rental income. Now you are getting money back. You are not offering. Logically, you claim deduction, therefore you will have to offer it. This gentleman said, logic and income tax need not go together. Always it is not necessary. Legal answer would be different from logical answer. I will not pay tax. Matter went up to tribunal. Tribunal went in favor of the assessee to say, income is something which should come first. If you claim a deduction refund of that deduction is not income. It's only a deemed income. Law must deem that as an income. Such deeming is available under business under section 41 and under other sources. Similar deeming provision is not there under the head house property, and therefore it is not chargeable. So, small matters, of course, the assessee was strong enough to say, I'll fight it out, and matter went up to tribunal and he was successful in it. Now, people like us will continue to talk like this, and department will, when they come similar to 41, a provision. Hopefully, let it be prospecting, right? So that's one aspect. Refund received in a subsequent. Now, interest on loan. Municipal tax is allowed only when it is actually paid. With reference to interest on borrowed capital, it will be on accrual basis, not on payment basis, it's on accrual basis. Now, the interest on capital borrowed is what the section said. Now, loan borrowed, some interpretation went on to say, when you borrow money for the purpose of construction, purchase, etc., qualifies. Subsequently, some other banker comes and says, why are you paying at 11%? We'll give you at 9%. The next loan is borrowed not for purchase, construction, repair, renewal. It is to close the previous loan. So one officer said, we will not allow this because that is not borrowed for the purpose of purchase or construction. And for this reason, amendment was made. Loan borrowed to close the loan borrowed for the purpose of purchase or construction. So that means first type of funding to close the first loan will qualify. Next time he does the same thing. Second borrowing to third borrowing to close the second borrowing. Strictly, if we read the law, that will not qualify. Again, such borrowing other than the first borrowing, such type of language is now necessary, similar to what we have in 48, previous owner. If that gentleman also obtained by way of gift, which previous owner to consider? That clarity has been introduced in law. Similar to that is not there, so this issue would come. Then, pre-closure of loan resulted in interest, additional amount to be paid. For some reason, the assessee would like to pre-close the loan. That additional interest paid, pre-closure charges, whether that can be claimed against the income from the rental income from house property. Interest is defined in section 228A. Interest on money, capital borrowed. In addition to that, any charges paid for the borrowing is what the definition of the term interest. So the charges will also qualify. The section went on to say any charges paid for not utilizing the borrowed funds, sanctioned but not utilized, bank charges, that will also qualify as interest. So that means that will also qualify as a deduction. Then interest on interest, again the issue would be in a slightly weaker wicket because money borrowed for the purpose of purchase, construction, repair, reconstruction. So now we are not able to pay this and therefore we are paying. So it cannot be said to be a borrowing for this purpose. It is borrowing to pay the previous interest. That's why additional interest comes. So it's on a very weak wicket, but still one SC has to challenge. Now, another aspect would be where more number of units are constructed and let out. Let us say 12 units, 15 units, etc. And the assessee receives rental income plus maintenance charges. And he has some common maintenance, common area, lighting, security, all these things. Now, if you club the receipts together, he'll get 30% deduction as per section 24 class B. But the amount of money he has to incur as an expenditure for security, common area, lighting, etc. would not really meet the requirements of the 30%, something more he has to pay. So now if the assessee says, this is my rental, on this basic rental, I'll go under house property, claim 30%, reserves this money for repairs, 3 years once painting, etc. I'll use this money. The monthly maintenance charges I collect from all tenants, I'll put it separately. What are all the expenses I'm incurring out of it? I'll account for separately. I'll offer this under other sources. So all maintenance charges received, all other expenses incurred in connection therewith. If there is a surplus, I'll pay tax. If there is a negative, I'll set off against house property income. So long as the bifurcation is reasonable. Collecting 100 rupees for maintenance and putting everything under rental and then seeking to set off these losses will be throwing open challenges. So long as the amount bifurcated between rental and maintenance reasonable, this bifurcation is possible and tribunals have upheld these propositions. Then a case where the SSE constructs in the ground floor shop, first floor shop, and there are other floors lodging. And now he has got rental income from shops as well as lodging. Let us say monthly lodging, not daily lodging. That's nuisance for him. Therefore, he has gone for monthly lodging. Once in a month, the tenant pays. So now it is not a daily lodging. Daily lodging, that portion will come under definitely business head. It's a monthly lodging now. Monthly only he collects rent, similar to what he collects from shops. Now in this scenario, ground floor and first floor he would like to offer under house property. The other floors he would like to offer under business, wanting to claim depreciation and all other attending allowances possible. Whether such bifurcation on facts would qualify for deduction and other consequential aspects. Monthly lodging by itself would not say it is equivalent to house property income. It has its own risk of maintaining that property. In regular shops or residential units, nothing to maintain from our side. Monthly will go and collect rental. But in case of monthly lodging, the tenant who is available will have to do some services for collecting monthly rental. So therefore, it is akin to conducting business. So that will fall under business. So bifurcation is permissible. Now, in which scenario, by properly marshalling facts at the very initial stage, SC would be able to get better advantage. At the very early stage, in construction stage itself, if he is able to plan this, the cost he has to bifurcate by valuation report or by maintenance of books of account, so that the cost of the building of floor attributable for monthly lodging, he can capitalize and claim depreciation. But cost of the shops, he can continue separately. That is required at the beginning. Then at the stage of construction itself, assuming for a moment if the SSE is an individual and he borrows money for construction, the timing of borrowing has to be properly planned. One contribution he has to give, and then he will borrow money from bank. One contribution goes to house property at the first floor, ground floor, and then the other floors he is using borrowed funds. That interest can be used against business income. Otherwise, it will come under house property to the extent mixed borrowings are there. Now, this planning, if it is done properly, at least at the initial stage itself, if it is done, it will really go very well. In SIRC, 7 or 8 years before, I was mentioning this, like this, another one episode I was mentioning. At the early stage itself, the SC is able to plan and do this, definitely it will go very well. Mr. Bhanushekar was sitting at the last row and said, which SSE does this? They are coming to us only after all the problems have come, not before. To which I said, Mr. Bhanu, if the SSE consults beforehand, he would be my client. If he does it after that, he will be your client. So, execution level, if there is a planning, at least it will give the SSE the benefits otherwise available in the law. Then comes source. Yesterday we received this type of Shoka source. We have old episode also. The SSE says, I have salary income and house property income. Some other sources interesting. In scrutiny, bank statements were very fair. Rent advance received. Well, officer says, rent advance received. I'll apply section 68. Identity, genuineness of the transaction, source for that person. I am not doing any business to put my money in his name. I am only having salary income, one property I purchased Those days for tax purpose, they used to purchase property, claim 80C, 24B. While let it out, that gentleman gave some advance money, which is appearing in my bank statement. There's nothing doing. Identity. See the bank statement. This day he gave rent advance, wire transfer he has given. Same name appears next month as rent. Same person has given. From somebody else I have not received. Identity. Genuineness. Whether that day he has accounted money or not. True. Otherwise, I'll go under section 68. How dangerous it is. Right? Matter went up to tribunal. Tribunal said, if the assessee doesn't have business, what interest he has got in routing his money in rent advance? Go by human probability theory. It would not be necessary for him to do so. So where there is no business, section 68 requires 3 conditions. One is identity. Here, same person has given advance, subsequently he paid rental. So identity proof. Genuineness of transaction. How many times he has received rent advance? What is that market prevalent practice there? 5 times? He has received 5 times. Genuineness proof. Capacity of the person giving money. For the purpose of rent advance coming under house property head, capacity need not be proved. Going by facts of the case and the human probability theory, person receiving advance need not go back and check whether the other person has got accounted money to pay. Today, the issue has got all the more compounded. Section 68 goes one step further to say source of a source. Whether that person from whom he has got, whether that person has got source or not. How come it is possible for a person who is letting out his property? If somebody comes asking for property, I say, where from you are going to give me this 50,000? To whom, from whom you are borrowing, whether he will give confirmation letter or not, his ITR, his bank statement, now itself you give, only then I'll give this property to you for rental. How is it going to be possible? Thankfully, tribunal said, this is a case where for this capacity need not be looked into. Genuineness of the transaction, identity of the person would be sufficient. Very welcome proposition. Oh, sorry. We're gonna reverse. There are some practices where instead of collecting monthly rental, lump sum money would be received. In Tamil, it is called bogium. In English, we call it usufructuary mortgage. All right. Now, assessee receives this lump sum money. Instead of collecting monthly 15,000 rupees, will take 5 lakh rupees. So, he will not be required to pay any rent. I will not be required to pay any interest on this money. He has received this 5 lakh rupees lump sum. He is not receiving any rent. Assessee doesn't receive any rent from this property. While furnishing return of income, assessee would say, I have not received any rent on this portion. Leave it. Act doesn't say so. Act says, annual value of the property let. Whether you actually receive rent or not is irrelevant. So we say, no, lump sum money is received and therefore no rental. It is physically occupied. We cannot claim vacancy. It is physically occupied by the tenant. And therefore, notional value has to be offered in case wherever the assessee goes for this usufructuary mortgage model. Now, there are some assessees who used to say, when the property is under construction, they'll collect this usufructuary mortgage to fund the project. Instead of waiting for project to be over, last few payments are pending, they'll collect this money and settle the vendors. Now we will say this money what you receive borrowed for the purpose of construction. Whatever usufructuary mortgage collected is nothing but money borrowed for the purpose of construction. We'll compute reasonable interest rate. The interest on this is nothing but rental. So let us say 5 lakh he has received 12%. 60,000 rupees is the rental. 60,000 rupees is the interest. Now rent received 60,000. 30% will qualify. On the top of it again 60,000 will become interest on money borrowed. So obviously the 30% will qualify as a deduction. And subsequently if this gentleman goes, again another borrowing comes to fund this. Again that will continue. The third one, what will happen? Again, the question mark would remain. But at least if the usufructuary mortgage is collected at the very construction stage itself, that notional taxation can be avoided. But if it is collected, first round is let it out for rental, and sometime later for some other financial requirement, he collects usufructuary mortgage from a next tenant, that would not qualify. But again, if he collects money for the purpose of making some investment, that 5 lakh rupees. Now, that 5 lakh, let us say he has invested in a business. We'll say this business, again, he is going to make money out of it. Less this interest paid, we'll say he has borrowed money, notional rental, equivalent to interest. From business, will claim offer under house property. If the source is established, the money received is used for this purpose, income of this is taxable, against which we claim. There also, if the money is borrowed, used for something which is not generating revenue at all, then notional rent on house property cannot be avoided. Firm having property under construction, partners funding, partners paying money for construction, interests ought to be claimed. Now, when firm lets out property and gets rental income, and partners have funded money, and let us say it's purely a commercial complex, monthly rental received, no other efforts involved. Firm will assess this income only under house property. Party small b will apply only where it's a business income. Now, partners given money from out of which property is constructed, rental comes, we are assessing under house property. Party B will apply only where there is a business income. Now there is no business income. So what will happen to this interest? Now again, interest on capital borrowed is what? Section 24(6). Whatever interest on capital given to partner is also interest on capital borrowed. That will also be eligible for seeking deduction under house property. But again, it's slightly difficult for assessing officer to accept it. So in which scenario, minimum capital for the partnership firm can come from him. All subsequent contribution for the purpose of construction can come from his family member. Let us say he only has got money. Let him give loan to his wife. Let wife give all the money to the partnership firm for construction. When partnership firm pays interest to spouse of the partner, under 24B can be claimed. And he in turn, partner can charge to his spouse, so that spouse will not have any income from this. Ultimately, again, income will come to the partner concerned. At least this transaction would help not inviting any more litigation. Only element is TDS will come. To that extent, one has to fund cash flow. Otherwise, no issue. If you charge interest, it will not come. If you do not charge interest, 64 will come. Again, income will come to partner. If you charge back to back, there is no problem. Land is in the name of the partner. Construction takes place in the name of by the partnership firm by taking the land on lease. Land is in the name of the partner. Construction is carried out by the partnership firm. The rental comes. And the income is accessible only under house property. That's the nature of construction. There is no business involved. In which case, entire rental will come to partnership firm. If it is assessed under house property, it will not build to the extent of building assessed under house property. If the land building put together is constructed by partner, let out to firm, and then firm let out to somebody else, it will come under other sources. Rent received, rent paid, no problem. Now building is owned by the partnership firm now. So building owner, partnership, therefore accessible under house property. Income is considered. Now what will happen to the land rent paid? Prior to 2012, there was one item in section 24, ground rent payable. That was deleted. Fine. With this, we'll close. Now, ground rent payable no longer considered as permissible. It is deleted in section 24. Now, what will happen? Land, building, put together rent will come in the hands of the partnership. Partnership will pay land rent to the partner. Partner will pay tax on the land rent. Partnership firm will consider the entire rental and house property. For ground rent, there is no deduction. So, double taxation to the extent of the land component. Now, what has to be done? In the let out, when they are letting out this particular property to the tenant, in the agreement for letting out, land rent, building rent, we set in the agreement itself. Now, to the extent of land, I am getting land on lease, I am letting it out. Building rent this much. Fairly, it is bifurcated and collected. Now, building rent will offer under house property. Land rent will offer under other sources. Claim land rent paid with or without small margin. To that extent, double taxation can be avoided. So that has to be taken care of while executing the lease deed with the prospective tenants. Then both land and building belong to partner. Both land and building taken on lease by the partnership firm. Partnership firm lets it out to somebody else. Subleasing. So definitely, if the activity is repetitively done in more than one case, not only this, in all other cases, it will come under business, or it's only state transaction and other sources for partnership. For a landlord, the partner, it will be only under house property. Now comes the number. Same property. Partnership firm does not do any other thing. Partnership firm pays to partner only 1.5 lakh rupees. But firm collects 4 lakh rupees per annum. The number, there must be some justification for the gap. Otherwise, what the officer would say, the annual value of the property is 4 lakh. You have offered only 1.5 lakh rupees. I'll substitute that by 4 lakh rupees. Firm will say, I received 4 lakh, gave 1.5 lakh, for 2.5 lakh, I'll pay tax. But in the hands of partner, and actual rent received 1.5 lakh, annual value 4 lakh, whichever is higher. For the 2.5 lakh, firm will also pay tax. The concerned partner also would pay tax. For the gap, there should be commercial justification. Otherwise, it is open for double taxation. Many occasions, as you would say, I don't want GST. Less than 20 lakh rupees, I'll give it to partnership. Let the firm collect market rent from the tenant. I'll at least get myself insulated from GST complications. He may not get GST, but he'll have double taxation for that incremental number. This is something which one has to keep in mind. We'll break for tea and come back to discuss the remaining things. Thank you.
Dear members, let's break for tea and reassemble within 15 minutes, please.
Well, we'll continue. And here, reading is difficult. Well, we'll continue. 30%? Yes. The query is, what would be the tax consequences for a partner? And the firm will receive 4 lakh. Firm will pay 1.5 lakh to partner, and 2.5 lakh subject to other actual expenses incurred, statutorily permissible deduction, firm will claim. Coming to partner, partner claims he had received only 1.5 lakh. But officer would say actual rent received or receivable 1.5 lakh, annual lettable value is 4 lakh, whichever is higher, I'll take 4 lakh, on which I'll give 30%. So in the hands of partner, instead of 1.5 lakh, 4 lakh will be substituted. Statutory reduction of 30% will be available in the hands of the partner. In the hands of the partnership firm, 4 lakh minus 1.5 lakh and any other actual expenses incurred, balance tax will be paid. The 30% will be available for partner, not for partnership firm. Now, when a firm, obviously other sources. It can be ignored, sir. For only land, rent component alone will come to landlord. As maintenance, all will be factored in the association. It will not come to the landlord at all. Now, business, of course, I have selected very less for business because few other individual HOA or partnership related matters we have picked up. We'll spend few minutes on this. Interest on partner's capital. Now, non-resident. Normally, interest on partner's capital will work out as per the rate in the Income Tax Act and the rate as mentioned in the deed. Accordingly, will work out, considering it. Now, in the middle of the year, one of the partners traveled abroad and stayed there. He became non-resident. End of the year, he became non-resident. Interest paid to partner. Now, interest to the non-resident partner will qualify for reduction subject to compliance of 40A1. Non-resident partner interest paid, section 194A subsection 3 says interest paid by a firm to a partner need not suffer TDS. 194A3 will not say resident partner, but entire 194A would apply only for a resident payment. For a non-resident payment, 194A would not apply, 195 would apply. So therefore, necessarily one has to see that for a non-resident partner, 195 tax reduction at source takes place. Otherwise, 40A1 would trigger. Many occasions, the person would not even say family run partnership. Son or daughter would have been admitted as a partner. They would have gone abroad for higher studies. We continue to close the accounts and carry it forward. For that son or daughter also, we only would have filed return of income also, offering this income, but without any TDS. So therefore, it is ideal to discuss. Otherwise, 40A1 would trigger. Now, 40A1A says 30% of the expenditure will be inadmissible. Whereas in case of 40A1, 100% of the expenditure would be inadmissible. So that difference we will have to factor. Now, that is on 195 for other than this case, sir. But separately we'll discuss. We'll confine to the facts of this case and later on we'll discuss when it TDS provision comes. Equally same for remuneration. What we are discussing for interest, for remuneration also same issue would crop up. Partner's remuneration to a resident partner 192 would not apply. For a non-resident partner 195 would apply. And naturally, even if the other person has offered income. Now, what will happen if we are able to demonstrate that the other person has offered income? 40A1, 40A1A, 2011 proviso. All the proviso below all these sections would say the other person has offered this as income, then obviously this assessee will not be regarded as an assessee in default. Form number 26A had to be filed. Earlier, we'll get the detail, fill it up, give it, and delay in filing will ask for condemnation, something. But now Form 26A has been made electronical. Now first, the recipient, who is his chartered accountant, add CA we have to give, and thereafter he has to upload. Then in that from traces, it has to come to TAN of the deductor. That has to be accepted. And immediately it will not figure out. After we add, it will take some time. 29th of October, we look out all these things. 31st October, we'll have to give tax audit report for this. 26A would not come. As a tax auditor, what we are going to do, in tax audit seminar we'll discuss. But it's something where one has to seriously look at. 26A, the proviso below 40A1, proviso below 40A1A, proviso below 2011 is not that very easy to technically comply with. Earlier law was very simple. Form 26A signed by auditor, produced before the deductor, matter ends from the date on which it is deductible to the date of other person filing the return, intragonum period, 2011 1 year interest has to be paid. Otherwise, no tedious disallowance would come. But today, 26A filing has, through electronic portal takes long time and it has its own technical glitches one has to address with sufficient time. Then interest to partner with differential rates. Of course, Section 40B says authorized by and in accordance with terms of the instrument of partnership. So authorized by and in accordance with. So whatever deed says, the deed says 12%, 12%. Deed says mutually agreed by partners but not exceeding the limit prescribed in 40B. How mutually agreed? There must be documentation, a resolution, etc. So differential rate permissible, not exceeding 12%. What is actual? Every year beginning we have resolution, fine. Differential rate permissible. Now what will happen in case partner pumps in money by borrowing? He borrowed a higher rate, gave it to the partnership firm. The firm can give only 12% max, but partner has to pay more. For him, the difference will be a loss. So that loss, so long as genuinely borrowed outside and he has to pay to fund the partnership business, that will qualify for deduction. Now, why should he leave this 3% loss? Now, instead of going by partner status, if the borrowing is going from family members can say, I borrowed 15% from outside, gave it to firm at 15%. So the 15% cost will sit in the partnership, not in the partner. That 3% need not suffer from partner's hands, subject to tedious provisions. Now, firm pays 12% to partner. Partner pays 9% to third parties. Now, we have a case where partner borrowed 2 crore, invested into partnership, money lending activity. That year, some bonanza, 5% interest per month they charged. The next year, it became bad debt. That's a different subject. But that year, continuously, that fellow paid 5% per month. Huge money had come. Now, interest has come to the partnership firm, from which it has paid to the partner. Now, also the firm has got huge share income. Now, interest has come. The partner says, I borrowed money, I paid to partnership firm. Partnership gives me interest, I paid interest, balance interest I am offering as taxable income net. I have got share income exempt under 10(2)(a). The officer says, you have invested money into partnership, which generated you interest income as well as share income. Because of this making investment, you are able to generate both interest income, share income. Share income is exempt under 10(2)(a). Interest income is chargeable. One source which generates partly taxable, partly tax-free income. Therefore, the amount of expenditure which you are claiming cannot be said to be allowed against the taxable income only. will invoke 14A and bifurcate in some reasonable basis. Right? Better we do something reasonably. Otherwise, whatever they claim reasonably will become unreasonable for assessing. Right? If we don't do it, fine. If we don't do, we can say no. Interest received, interest paid, share income exempt. Then 14A will come. 14A subsection 2 proviso as well as the form, etc. Assessee can go to litigate and say, this 14A, if you carefully see, section applies to me, but the rule prescribed, by the way rule prescribed, my case will not fit into it, therefore rule fails, section fails. One view of doing that. Some reasonable disallowances will avoid litigation to a larger extent. Designing transaction to see that when huge share income comes for those funding, assessee himself doing it, not advisable. By family members, at least this 14A could be avoided. This way, one can plan when the transaction results in huge surplus from partnership firm, considering the nature of the business. Cash transactions. Gradually, it is vanishing from the system, but still, in certain industries and certain type of transactions, cash transactions are still there. And assessees are always novel in doing many things and trying to project in a different way. From our side, what is that we should take care when we are reviewing books of account? Certain instances where we will have to be a little more careful, because later on, when scrutiny comes in a faceless era, sometimes even the tally PDF gets uploaded. After that, only these things are coming to our knowledge. Therefore, one has to be a little more careful on these sort of aspects. One, month-end tally will show cash account. They'll put an enter onto that. Every month end, there will be a balance. We go and get daily balance, sometimes negative. Month end, everything balance positive gets uploaded. After the data gets uploaded, officer does in PDF, from PDF to Excel, he works out and says, these are the dates on which cash negative is there. To that extent, you have some other income to fund this. We will not consider this as permissible deduction. We will not allow this claim. To that extent, 68-69 series comes. This is something which one has to see. And some part-time accountants, without a need to go and discuss the facts with the SAC, closes the accounts faster by taking certain clearings as proprietor capital. Certain clearings will be there. Will not have time to go and discuss. So he'll credit to proprietor capital. So incremental capital has to be examined. Otherwise, sometimes it will create difficulty. The money might have come from somebody else, gross receipt or a revenue receipt or a loan, etc., would have been credited to proprietor's capital. Withdrawals. Money might have gone to some other account by way of RTGS, NEFT. You would have shown as proprietor drawing. That is to certain extent permissible. You would have shown as cash drawing. And that cash might have been used for expenses. We remove that, there will be cash negative. So these are instances we have seen. Therefore, these bank statements, from bank statements, the nature of description given has to be test checked at least. Then withdrawals, ATM withdrawals, 2,000, 3,000 rupees, all in the cash book shown as source for subsequent investment. By conduct, if you take 2,000, 3,000 and accumulate all these things and say one day 4 lakh I've gone and deposited in the bank account out of this, by conduct it will lose. One can litigate, but still these are cases where one has to exercise a little more care, because today cost of litigation, the 20% payment, etc., all that has to be seen. Otherwise, it will trouble. And we have cases where opening balance itself 15 lakh. Every month, or rather every Saturday, he draws money. And every Saturday, a portion of that only he makes as weekly wages. Balance gets accumulated. Suddenly in February month, he wanted to purchase a vacant land. Therefore, all this money is deposited in the bank and purchased vacant land. Now, you have opening balance of 15 lakh. Every week you take 4 lakh and spend only 2 lakh. Already you have got 15 lakh. What makes you to draw 4 lakh and give only 2 lakh? Again, another 2 lakh you accumulate. And February month, all this accumulation you go and deposit. Officer says the first 15 lakh you did not have. Therefore, you draw 4 lakh. That 15 lakh is not there with you. Out of 4 lakh, you have spent 2 lakh for weekly wages. Other 2 lakh also you have spent. That's the reason why next 4 lakh next week you are drawing. If that is available, what makes you to draw? So all these amounts have gone somewhere. Some other money has come in the month of February. You are not explaining it. Unexplained. 69 series will come. This is something where its flow has to be properly examined. Then direct deposit in bank account. Now we have section 269 ST. Only a borrower was in trouble in 269 SS. The same borrower is in trouble in 269 T. Now 269 ST makes even the person giving money subsequently receiving back is also in trouble. I have given money to somebody, that gentleman makes payment to me. I'll get caught under 269 ST. I'll have to be careful. I should tell him, don't give. Only instrument, 2 lakh above, you cannot give me cash. This fellow went and deposited in my bank account. Bank statement says cash. I have given in the invoice bank's detail to make him payment quickly. But he uses that information and he deposits in my bank account cash. Statement clearly says cash deposited. Now in that case, revenue would say it's you have deposited. Now we will have to see the evidences. If that branch in which it is deposited happens to be a non-home branch, he has deposited in some other places. He is a debtor of mine, in his hometown he has deposited. I cannot go and prevent him from doing so. Reasonable cost to get out of it, possible. But he is situated in some other place. Deposit happens to be in my home branch. And I say he only came and deposited it. Very, very tough time for assessor to convince the case. Home branch, non-home branch would help some way to a certain extent. And payments made to group concerns, other places, suppose 48.3 and 48.2. Reasonableness, one has to see. 48, I think we have already discussed this, but the cost of repetition I'm saying in this hall, last time when I came we discussed. 48.3 says expenditure incurred in respect of which payment made in the same financial year. 48.3a says expenditure incurred in respect of which payment made in the subsequent year. So now expenditure incurred in respect of which payment made earlier. 48.3, 48.3a, both would not apply. So advance payment made 48.3 and 48.3a. It's again defense we can make use of. Tomorrow we should not say to our client, do all this. And all the purchases one day earlier he'll start writing cash payment. And a defense case at least we can make use to say payment made first, expenditure incurred later on, penal provisions to a certain extent would not apply. On defense case at least we can make use of it. Some tribunal judgments are for and against, of course we can make use of it. That's one very interesting propositions coming. 44 AD cases. Somehow department wanted to give some relief to SECs, small people, but our assessees have stretched it to the extent possible. And now jurisprudence started developing. 44 AD. Eligible business, 8% cash receipts, 6% banking receipts, income. Nowhere the law says, in spite of your income offer this much will give you immunity. You have to offer your actual income. Actual income is more than this, offer that. Actual income is less than that, we don't compel you to offer this. Offer your actual income, but certify through a chartered accountant that this is your actual income. Law never compels a person to offer this minimum. Offer your actual income. But there are cases where if the income is less, the SC says my income is less, better you audit and certify. We will say better we'll offer that income. Instead of auditing your account, it is better we will offer that income sufficient, because that's the quality of the accounts. Nowhere law says you will have to offer this much minimum, but actual income has to be offered. But this principle is somehow stretched to fit into facts. 139.9 talks about defective return. At 139.9 says where no books of account maintained, on P&L for information, on balance sheet for information, we will have to give gross sales or turnover or gross receipts, gross profit, expenses, net profit on P&L side. Balance sheet side, debtors, creditors, inventory, cash. 44 AD return contains this information. 44 AD says so long as you offer this percentage, you are not required to maintain books of account. 139.9 says where you do not maintain books of account, you have to furnish these information. So in 44 AD cases, at least these are required to be mentioned. Many occasions people will say, the assessees would say, no sir, put cash 50,000, that's all. Return will go as cash 50,000. Opening balance 50,000, closing balance 52,000. No other information again. The case gets picked up for scrutiny. In that 4-4 column, we have only cash balance 50,000, 52,000, nothing else. Now the collections in the bank account, some of them are trading collections, some of them something else. The collections in the bank account more than the turnover reported by the SSE, on which he has applied 8 or 6%. The officer says, now you got this much bank collection. I leave your 8% cash collection. 6% on bank collection you have said. This is your bank statement. This is the total collection. On which all you have applied 6%, which are you have not applied, for which what's the reason? We are not asking to maintain books of account. We are asking to explain the credits in the bank account. That is something which we cannot avoid. So in which scenario, we will have to say these are collections of opening balance of debtors. Now our return says sundry debtor blank. And year before that year, blank. Consistency. So year after year for that SSE, sundry debtor, creditor, inventory blank. Cash only 2,000 plus or minus goes. So the theory that debtor collected at the first instance would fail, but we can substitute saying we omitted to give that, but at least we can convince by saying we say account copy of the debtor, other side confirmation, etc. We'll be able to do some additional work and give it. First, if you are able to say this is the collection and this is the current year, at least reconciliation of the debtor balance and creditor balance. If the collections are more than the sales turnover, etc., on which we are applying percentage, that reconciliation would help. Otherwise, officer would say two extremes. Certain officer would say the balance also sales unreported, on which I will apply the same percentage. Damage is less. Some other cases, the rest all they will count and say, these are, you yourself said these are not sales. Rest are all unexplained. 68 to 69 ABC, whichever section they feel, will put it there. We'll say which section is correct, which is not correct. Another litigation will start. Right? So now the collection in the bank statement versus the turnover. If the turnover is less, opening balance of debtor, then something should be left for closing balance of debtor. We are not closing business that day. Some debtor must be there for the closing also for next year collection. So that reconciliation is something necessary. Or the credits have to be, at least larger credits should be picked up to say other than debtor collection, something else, rent advance received or loan received with some confirmation. At least something should be there where there is a gap between what is the amount deposited in the bank versus the gross receipt shown in the return. Then cases where the officer has picked up the case for scrutiny, saying this bank account of yours have got 80 lakh rupees cash on bank. We would like to check. In the ITR, details of bank account we have to give, including bank account closed during the year. This bank account is missing. Assessee has given 3 bank accounts in the term. Only 3 bank account he has given. This bank account on which this 80 lakh rupees deposited is not there in that particular information of bank accounts. The officer says, now assessor says, this 80 lakh is only my Sunday debtor collection. And the officer says, this 80 lakh you have never intended to show. Whatever other bank account turnover, fine. Now this 80 lakh is an unaccounted bank. The entire 80 lakh rupees, I will not consider. If the same nature of business, same activity, certain more debtors have paid, or in the same debtor, some money had come in the bank account, some money has come in other bank account, nature is explained. We can say they are business collections, but unreported. My turnover reported was 1.2 lakh. Add this, which I did not show this bank account, these collections I did not show. Add this 70 lakhs more. 120 will become 190. 70 lakhs, same percentage, 8 or 6%. Now it has come in bank account as cash deposit, 8%. It has come as instrument transfer, 6%. If the credits, nature of credits are explained to be business collections, even it is unaccounted, during the course of the hearing, 8 or 6% can be said to be offered against it. If the credits in that have no live link with the business receipts, some straight transactions, then assay has to explain. Otherwise, it will invite him trouble in terms of 68 to 69C. Now, therefore, accounts available, the bank and the details of bank accounts would match. Otherwise, this problem would crop up. Then, sometimes profit on sale of assets. Presumptive income will cover only business income. Profit on sale of assets will not come under presumptive income. If there is a capital gain, that cannot come under presumptive income. We will have to independently factor and consider it. Otherwise, it will invite trouble. Now, peculiarly, SC says 120 lakhs is my gross receipt. I am offered 8%. Did not distinguish between 6 and 8, offered 8. Officer says, what do you do with the remaining 92%? You have offered 8%. What happened for the remaining 90? SC says, that's not our business now to discuss. Section says I should offer 8%. I have offered. What did I do with 92%? So long as money doesn't remain in my bank account, fine. If the money remains in bank account, trouble. I offer 8 or 6%, I have 42% lying in my bank account, I am in great trouble. If I have taken the money out to the extent of opening balance 8 or 6% plus depreciation of that year estimated, only remains in my bank account, deemed to be business expense. Whether actually business requires that expense or not is irrelevant. So long as cash flow supports, this is deemed to be business expense. Eleki Shutter, Bangalore bench of the ITAT judgment, followed by several judgments to say, ASIC cannot be compelled to prove that he has expended the balance 92%. Law takes that as a deeming fiction. But revenue would not counter only with that. It will ask you to compare the bank balance, debtor, creditor, that has to be explained. Are we in the same track? Yeah. Fine. Given him the remaining time available, we will pick up in all the slides 1 or 2 important points alone. So capital gains, at least for business, we have number of years for which records have to be maintained. For capital gains, no such restriction, no such concession. If the acquisition cost is to be explained, we will have documentary evidence. We claim some improvement. If the improvement falls beyond 8 years or 10 years, 2001 we start and thereafter 23 we compute in between 23 years are there. After 8 years some improvement is given. The officer asks for proof of improvement. We can't be in a position to say beyond 8 years, therefore I am not required to show. So the improvement cases, necessarily proof has to be preserved. Otherwise, the year of sale, when we are claiming this cost of improvement together with indexation, it will throw open challenges. But there are some cases, practically we have so much of difficulty. A limited company, somewhere in 2001 purchased a property, 2003 somewhere they incurred some improvement cost, claimed it in 2021. Because bank has auctioned that property, they calculated all this and reported. IBC proceeding started, no records are there. State Bank took over their premises. Now in 2022, the returns were started for scrutiny. Now 2003 improvement claim, they are asking for a proof. As they say, State Bank has got our office, we don't have office at all. State Bank took over the possession of it. Faceless, how can we say all these things? Whether State Bank took or other bank took, they don't mind. They want you to give the proof of improvement. 2003 to 21, good amount of improvement, good amount of indexed cost for it. That gets disallowed, sizable revenue. Company is now least worried about it because already it is IBC. This demand will also get added to the list. What is there to worry for them? But somehow the promoter says, I do not want this to happen. Somehow let this number get reduced. And thankfully, we went to ROC, collected the paper, balance sheet. 2001, 2, 3 we asked. 2002 came, 2004 came, 2003 did not come. That's the year in which improvement took place. Because in ROC, some year before, only manuals, they were unable to give some earlier fantastic conclude. They said 2002 we are able to get, 2004 we are able to trace, 3 somehow it is not there. And from 2002 I said, see 2002 current column, in 2004 see the previous year column, compare 2021 I'll claim improvement. With that belief in 2003 whether I included it. I would not have anticipated my company will run at a loss in 20 years later. This is audited accounts available in the records of ROC. Therefore, this improvement cost has to be accepted without any further evidence for it. That's how we were able to file details to the NFAC. But we'll have to wait and see how the officers is going to take up the matters are pending. Probably March orders would come. Only in the end of March we'll get all the orders, right? So therefore, this has to be seen. And one for 2001 value have to be substituted. Value asset 1 for 2001. Any cases where cost is prior to 1 for 2001, 1 for 2001 GLV has to be considered in substitution where it is beneficial. Once you take 1 for 2001 GLV, the improvement is deemed to be embedded therein. You have incurred cost in 71, 81 you improve, 91 you improve. Thereafter in 2000, what would be the market value of that property? So 2001 you are considering the value. That gets covered. Now 2001, whether it's a market value or the guideline value. That's the question. So guideline value sometimes will be less or market value will be more. So therefore, some people resorted to considering the market value as certified by valuer. Many occasions what happened? People took the 2022 sell rate, reversed indexation, arrived at the fair market value of 2001, went to their valuer, asked the registered valuer to give that as value prevalent in 2001, irrespective of the guideline value, and said, this is the FMV, not GLV. I am substituting it, then indexing it. My capital gain will be in last 2 digits, that's all. All other things wiped out. Now, amendment came to say, if there is a GLV on 2001 and FMV, forget FMV, take only guideline value. Stamp duty value has to be considered. Sir, there are certain practical challenges in respect of building. Now, in stamp authorities reckoner, for building also value is there. In our state, some of the people in the crowd, in our state, there is one lacuna. We'll discuss, others may have different experiences. If there is a building, today, if the same building is constructed, what would be the cost? Current cost. They'll evaluate. Tamil Nadu's manual says so. How many years this building owed? Each year 1% depreciation. Now, today's cost of construction of that building they'll take and reverse it. If I say the building is constructed in 2003, now 20 years old, today's valuation they'll take and reduce 20%, each year 1%. So 80% of today's cost is the value as at 2003, according to Tamil Nadu stamp manual. Beneficial provision for us. That year you would not have incurred that much cost. Today's cost and reverse by only 20%, 23%. Prior to 23, prior to 2001, you can go by valuation. After 2001, anyway, actual cost has to be considered. So this working is available in the stamp law, and registrars are doing this working. We can go and get it from the sub-registrar office. Then I'll take this only this one problem. Guideline value, or in terms of law, stamp duty value is considered as a substitute for the actual apparent consideration for the purpose of section 50C, 56(2) and 43CA. When a person is doing on a personal account this transaction, not as a business transaction, seller will be hit by 50C, purchaser will be hit by 56(2). When a seller does this on a business transaction, he will be hit by 43CA. When a purchaser does this as a business transaction, as of now, there is no section. The market value of the transaction, what I am doing, is more, but actual consideration is less. Purchaser, there is no trouble. For a seller, if he is a businessman, 43CA. If he is doing on a personal account, 50C. If I am purchasing on a personal account, 56 to 10. So that map closes. Now, in all these three places, government came with a concession. So long as the percentage gap between the stamp duty value and actual consideration, originally they said 5%, thereafter they came with 10% for some COVID related, for some period alone extended, again now today again 10%. The gap is less than 10%. You don't need to substitute the SDV. You will have to consider only the actual consideration, apparent consideration in the document. Now this is for 56 to 10, 50C, 43CA. Now we have 194IA. Now 194IA got amended to say, if the actual consideration and stamp duty value, originally 194IA said if the consideration is above 50 lakh, 1% for our resident cases. Non-resident will not come there, it will come under 190. Amendment came to say, if the consideration and SDV you compare, SDV is more than the consideration, 194IA should be applied only on the SDV, not on the consideration. But the gap is less than 10%. Technically, by reading 194IA, even if the gap is less than 10%, from the deductor's perspective, he has to consider only SDV. 194IA does not say if the gap is less than 10%, go with actual consideration. The gap is more than 10%, go with SDV. TDS provisions do not factor this 10% reduction. It goes only with higher of the two. Now, from the deductor's perspective, if the SDV is 60 lakh, 57 lakh is the apparent consideration. The deductor has to go with 60 lakh. Nowadays, the state's registrars are asked to ensure that 1% is calculated on SDV, not on apparent consideration when it is less. Now, even if the gap is less than 5% or less than 10%, the registrars insist, you see all other things in income tax, at least 1% on STB you should produce challan. So now 60 lakh is the apparent STB, 57 lakhs is the apparent consideration. On 60 lakhs, if tax is deducted, when the recipient's point of view, when you are filling up the return, in 50C at least you will say apparent consideration, 50C value will fill up in the return. When the gap is less than 10%, automatically whichever that lesser amount will take, in the table relating to TDS, this 60 lakhs income offered, 1% will come under capital gains. In the capital gains chapter, will go and see at least the 50C value you put 60 lakh, gap is less than 5%, therefore you did not offer the balance, the credit will come. Now, if at all the assessee happens to be a businessman, he will offer under business, but his consideration reported is only 57 lakhs. But in the TDS table, it will say 60 lakhs. For the 3 lakh, the system will say you have not offered the entire consideration, why TDS should not be given credit to you. All right. So, unless this 10% reduction is properly factored in 194IA, at least in the case of 50C, it will escape. But in the case of 43CA, it will throw open some challenges while furnishing return of. Now come to 56 to 10. Transactions are reported in TIS. There also it will say, sub-register will say you purchased a property for 60 lakhs, but you will say I have purchased at 57 lakhs, no difference. But the numbers will throw up some challenges. Therefore, this fine-tuning is warranted. Otherwise, at least at a lower level, we'll have some difficulty in sailing through this. The assessee has got a property from his father who acquired it out of his own funds. Assessee received it from his father, father's case self-acquired property. For assessee, it is devolved. Now he sells this property. Purchaser says, better in the document is your son and daughter sign. I do not want to land into trouble later on. Let them be signatories. Because of the request of purchaser, he made his two sons signatory. So total consideration, 3 people name he gave, 3 people name he deducted tax at source, made the document 1/3 and then registered. Now father has to report the entire income, file return, claim TDS. Now TDS reported in 3 people name. Father has to offer the income in his name. Now father will calculate the capital gain in his name, offer the income. TDS will sit 1/3 here, 1/3 in remaining 2 sons' name. In TDS table, we have a provision to move TDS from one name to another name by clicking rule 37BA option. So from the person in whose name TDS appears, you can say consider in other hands, it will push off. And in the hands of the person whom you want to take credit, in TDS table, you go and put in others' name deducted, fill up everything, file return, you will not get credit. Right? Logic doesn't go. Here you have pushed. Therefore, in the name of the person in whose name it's actually deducted, it will push. He will not get money. But in the name of the person you want to take credit, the same TDS table you put deducted in other hands, PAN, number, gross receipt, offered under capital gains, all that you fill up, you will not get credit. In ITR, there is another place, income of other person included in your total income. In that table, we'll have to say name of the person, PAN, head under which offered income. If that is not properly filled, by just updating in TDS table alone, system will not capture. So now what will happen? That person in whose hands actually TDS sits, it will push off. But the person in whose name you wanted to take credit, In TDS table alone, it will be there, but system will not recognize it. It will cross verify with income of other person included in total income table. In that table, if the income is not updated, how many number of times you file rectification petition, TDS credit will not come. So therefore, what needs to be done? Income has to be offered in one status wherever you work. That to be, but correspondingly, this table has to be updated. Otherwise, system will read this table as empty. Therefore, the credit which is coming from the other hand will not be considered. The next is a case where a person has converted his capital asset into stock in trade. And then he has contributed that as that stock in trade to a partnership firm engaged in the similar business. Firm, while accounting it, treats the fair market value. Now he has converted capital asset into stock in trade, then introduces to partnership firm. While introducing, firm takes the FMV, not to cost. Now in between there is some gap. What's the taxability? So question before. When that gentleman converts this from his capital account to current account transaction, converting that into a stock in trade, under 45(2), that event would trigger taxation, but tax is postponed. 45(2) says it will be deemed to be transfer, but the timing of payment of tax shall be postponed to the year of sale of such stock in trade. To the year of sale or transfer of such stock in trade. The year in which such stock in trade is sold or otherwise transferred is the language of 45(2). Now, year of conversion transaction triggers capital gains. We work out capital gain, we don't discharge tax there. We'll calculate capital gain. That means indexation stops there. Indexation will not move up to the year of actual sale of that asset. It stops here. Now we calculate capital gain and hold it. Now here subsequently, he introduces that asset into the firm as stock in trade. 45(3) will apply when there is a capital asset introduced by the partner to the firm. When a current asset is transferred by the partner to the firm, similar to 45(3), there is no such provision in the business chapter. So, the year in which partner introduces the current asset to the partnership firm, similar to 45(3), there is no provision. Therefore, no taxation. Now, the very same 45(2) says the such stock in trade is year in which such stock in trade is sold or otherwise transferred by him. Now, the stock in trade is ultimately sold by the partnership firm. When I convert a capital asset into stock in trade, and that stock in trade is ultimately sold by me, the quantified capital gain will get taxed in the year of sale of that business stock in trade. When I convert the capital asset into stock in trade and quantify capital gain, but the ultimate sale is not happened by me, the previously quantified capital gain will also fail. Because 45(2) says that such stock in trade is sold or otherwise transferred by him. The person who converted must sell to tax this previously quantified capital gain. Now this person is not now selling. Firm is selling. So therefore, you may quantify capital gain, but it will remain. And subsequently, firm will proceed further. So a conjoint, yes sir. And that is capital asset converted into. When I convert a stock in trade into capital asset.
Now here, stock in trade is subsequently never converted into capital asset. That section. I'm not converting. When I am giving as a current asset only, as a partner, I can contribute to very many things to partnership, need not necessarily everything as a capital asset. What I am giving, my partnership firm is a jewelry business. I've got jewelry. I've also got a jewelry business. As a stock in trade, that one portion of the stock in trade I can give. If I've got jewelry as a capital asset and I gave it to a partnership firm, then capital asset converted to stock in trade theory would apply. My inventory I'm giving it to a firm. It's already an inventory of mine. In which scenario, I'm not converting back into capital asset and thereafter giving it to partnership. That theory would not come. Right? The case where the SSE has entered into a sale agreement, received 10 lakh rupees advance. There are some encumbrances. He promised that he'll clear off that encumbrance as quickly as possible and sell. Knowing well there are some encumbrances, the buyer stipulated a condition to say, you don't clear the encumbrance, you should not only return the 10 lakh to me, you should also give me another 10 lakh. You are promising me to you'll clear encumbrance in 3 months and sell it. For that reason, I'm entering into this agreement. Next 3 months, he could not clear off that encumbrance. He said, okay, fine, I'll pay your 10 lakh, another 10 lakh. Now, from the person who received this 20 lakh, how law will unfold? He has given 10 lakh first, now got 20 lakhs. Another 10 more lakhs he has got. What will be the taxability of this another 10 lakh what he has received? Is a question before us. Now, SSE would say, I gave 10 lakh, I got 10 lakh back. Matter ends. For the other 10 lakh rupees, I did not incur any cost. Cost is indeterminate, therefore no tax. In order to say cost is zero, section 55 should have a list. Section 55 says cost of improvement in these cases nil, cost of acquisition in these cases nil. All other cases cost is indeterminate. This is University Supreme Court judgment would continue. So SSE would say, I have given 10 lakh, I got back 10 lakh, matter ends. For other 10 lakh rupees, I did not incur any cost. Cost is indeterminate. Therefore, I would not require to pay any tax thereon. But interestingly, our tribunal said, how did you get this 10 lakh? Because you originally gave 10 lakh. But for you giving 10 lakh and entering into agreement, you would not have got a right to demand balance 10 lakh. So that means we'll rework the calculation. Money received 20 lakh, cost 10 lakh is your profit. What is short term capital gain, long term capital gain. Plan for it. So tribunal reworked it, made it taxable. All up to 31/3/23. From 1/4/23, section 55 got amended to say any other asset nil. Any other asset. So there is nothing to list. Any other asset, any other right, not asset, any other right. Now you have a right to demand this money for which you are getting this 10 lakh. The right to ask for conveyance, not able to get, therefore you are getting this 10 lakh. Any other right where cost is indeterminate will substitute 0. 1/4/23 onwards, these are going to be history. SSE has to pay tax and get rid of. Null effect. No longer we'll use that case law, sir. The idea behind that is for this, you have 4-story building. It has been 40 years. Now FSA has gone up. Some builder comes and says, I'll make it a 6-floor building. 4 floor for the same tenant we will give. Also we'll give some cash and we'll sell this 2 floor and I'll get more money. Some additional cash given. The SC used to say, my land I've given, my land and building I gave, I got more FSI, resulted in little more cash, for which I've not done anything. It's any other right, but it's not defined in 55. Therefore, no tax payable. To pull out that, the amendment had come. Now, not only that, all other cases are getting caught in that. Somewhere, revenue tries to hit somebody. Somebody is very vehemently plans and gets a benefit. Revenue would like to put somebody. But in the process, many other cases are gone. Classic example is charities. Every year you will have amendment in charity. Now, genuine charities have to seriously think whether they have to have this form to do it. Otherwise, they can find good alternative of doing charity independently rather than going under this policy. Now 55 amendment will pull out all those things. Now, it's a case where assessee entered into an agreement for sale of immovable property. Just 4 or 5 days before the date of registration, the buyer comes and says, I do not want registration. I'll give you whatever already I've mentioned. Give me power of attorney. Many of the cases, the assessee feels, okay, anyway, I've received money. What's the problem with that? So I'll give power of attorney, possession, all previous documents, everything I'll give, get money. Afterwards, that gentleman will make into smaller plots, sells to various people, gap between SDV and actual consideration, no regard to all those things. And he will make all the sale in all the documents, he'll say so and so principal on his behalf, validly authorized power of agent. And very interestingly, he will give the permanent account number of the owner. Power agent driving license he'll give. So what will happen? All these documents will get reflected in ASTS. Our assessee thought, okay, 50 lakh rupees is my consideration. That was what I've received. That gentleman would have sold for 1.5 crores to various people if you aggregate. The department will say, you have sold it for 1.5 crores or a lakh. No, I've received only 50 lakh. Balance difference, trouble. So, in a case where the assessee says I've received only 50 lakhs, precautions have to be taken to ensure that some written agreement to say over and above whatever is belonging to only the power agent, he will discharge the responsibilities and taxabilities. If that is taken care of, at least to certain extent, the seller or the landlord will be able to sign up. And if having done that, that gentleman did not file return at all. Finished. In spite of all these things, primary responsibility will come here. So at least if he is discharging the responsibility of paying taxes, etc., get that information. Government wants revenue of 1.5 crore. 50 lakh I have shown. Balance 1 crore business income for him. Gross receipt is shown. Difference all he has claimed some expense, pay balance. At least to certain extent, this can be avoided. Otherwise, it will be a trouble. Business income, he's into the business. Sir, there are two things. Under income tax law, you will say something. In the stamp law, you will say something. They will be contradicting each other. In a stamp law, when you register power of agent, you will say power agent did not pay consideration, any consideration. If you say something otherwise, it will invite stamp duty of 9%. To avoid that 9%, this is happening. But thank God, this sort of information is not passed on to state registration department to prosecute these people. If you register a stamp, in a stamp proceeding, you register power of attorney saying I have not received consideration, but physically Department of Income Tax says consideration is already passed on. This document is liable for prosecution. The people who have entered into this agreement should go. But thank God this is not gone. Government department, Income Tax department collect tax and satisfies. Beyond that, it doesn't go. To that extent, it is over. Interestingly, two brothers in the early days of their life, very good chemistry working on, jointly did some businesses, purchased some properties. Sometime later, family had grown, they wanted to settle things comfortably for their respective families. Therefore, wanted to make partition. Now, Mr. A and B had got 8 properties over a period of time. Now, finally, they've decided based on the market value, 3 should go to B, A should have 5 based on market value. Now, what to do for this to have perfect title? Whatever A should receive, 50% already has got. Balance 50%, other person gives gift. Each document prior to 2023, April 1st, 29,000, today 50,000 in this Tamil Nadu stamp law between blood brothers. Now, A should give to B. So he executes release settlement deed in favor of his brother for the remaining 3, so that he will get 5 completely, he will get completely 3. In one document, here 50,000, here 50,000. They won't have the title clear. 5 separate documents, 3 separate documents, 8 into 50,000, maximum 4 lakh. But property value running into crores, 9% of which will be running into crores. Therefore, they say, I have given gift to you 5 properties, my 50% share. You have given me 3 properties, your 50% share to me. Therefore, you are owner of 5 property in full. I am owner of 3 properties in full. Paid stamp duty, settlement. I have given gift to you for these properties 50% share. Other cases you have given to me, matter ends. Stamp duty paid, document clear. Now, what do you mean by gift? Without consideration, love and affection as the only consideration, we will have to give. By the way you transact, you have given 50% share of the property of these 5 to other person as because of love and affection. And opposite love and affection, he has given 3 properties 50% share to you. Crisscross love and affection. Right? So now what happens? If the number matches substantially, you have exchanged 50% right of 5 properties for 50% right of 3 properties of your brother. From the other side, 3 properties 50% is exchanged for 5%, 5 properties 50%. Now, revenue disregarded the 2 types of gifts and says, you have exchanged 5 properties 50% share. He has exchanged 3 properties 50% share. Both of you pay capital gains tax. Both of you pay. Matter went up to Madras High Court and failed. Timing of the event. The day he gives, one short span of time, the other person gives. We as professional would say, sir, don't do at same time. It will throw open challenges. Do in this financial year, do in the other financial year. Very risky propositions. We will say something, but chemistry in the family we will not know. When they start doing partition, slightly, initially things will start moving comfortably. When the settlement slightly starts picking up ratio, which one to be taken by whom, etc., family will start contributing for so much of fuel to the fire, and then you say, today I will give 50% to my brother. He will give me after 2 months. Finished. Deal will stop there itself. We may have tax as a consequence, but there are so many chemistries working that will go against the SSC. Sometimes it will not go well. I have been repeatedly saying this example. One of the old Tamil films of Bhagiraj that will say, he was a mathematics master for, I would not mentioned already, but still I am repeating this. Mathematics master for a 3rd class in a school, that film. So he'll ask a student, say, in a vernacular language, he'll say, உங்க அப்பாட்ட நான் 10 ரூபாய் கொடுத்து அவர் எனக்கு 3 ரூபாய் திருப்பி கொடுத்தா உங்க அப்பா கையில எவ்வளவு பணம் இருக்கும்? That fellow will say 10 rupees. கோவம் வந்துரும் அவருக்கு. இன்னொரு பையனை கூப்பிட்டு உங்க அப்பாட்ட 10 ரூபாய் கொடுத்து அவர் எனக்கு திரும்ப 3 ரூபாய் கொடுத்தா உங்க அப்பா கையில எவ்வளவு இருக்கும்? 7 ரூபாய் இருக்கும். இந்த பையனை திரும்ப கூப்பிட்டு உங்க அப்பாட்ட 10 ரூபாய் கொடுத்து அவர் எனக்கு 3 ரூபாய் கொடுத்தா எவ்வளவு இருக்கும்? 10 ரூபாய். உங்களுக்கு கணக்கே தெரியல. உங்களுக்கு எங்க அப்பா தெரியல சார். அவர் வாங்கினா திருப்பி கொடுக்க மாட்டார் சார். So we are only reading the sections. Chemistries will vary from family to family, person to person. So this sort of planning sometimes will put them into extraordinary trouble in the family. இன்னைக்கு காலையில அவர் கொடுத்துட்டு நாளைக்கு வந்து கொடுங்கன்னு சொன்னதே தவறு. There are cases where brother and sister's husband, morning father gives in favor of sister, afternoon he gives to the brother. Sister's husband says, if you don't give this first, give this first. Now, one property inadvertently from brother, it has to come to sister. But in family, they have purchased in the name of the son. The brother-in-law says, let him give this first to me. Thereafter, let father give to him. Token obtained for father giving to son 10:30 in this registration department. Son giving to his younger sister at evening 2:30. This son-in-law is not accepting. He'll change the token. Not acceptable. After your father gives to your son, if he refuses to give it to my wife, whole deal should stop. How to stop after property is already gone? Let him give to my wife first. Let us start the remaining thing. And you say after the financial year is over, give all this property. Who will accept all these things? Right? Definitely things will not go, chemistry may not go well in the family. So certain matters where we should not do only for the principal reason of tax planning. There are so many other factors playing role in the family, and we'll have to factor that. Many occasions this emotional content is very difficult to play, and of course as a professional ideal we should step out of that. Otherwise those people will come and sit and unnecessarily pressurize emotionally, and all that we'll have to answer. That's where sometime many occasions we'll get into that, and later on one out of the two will start always cursing us. That's a nuisance value. And sometimes they will go to the extent of inviting us to the court. All that nuisance are happening. So better we'll have to somehow step out of this plan. Yes. All that you do family arrangement, all that you do, sir, ultimately what happens? Ultimately what happens? Yes, sir. Family settlement requires little more planning, sir. You will have to have some dispute prior to that, and then to settle the dispute, all that you have to create, and then it can happen. The problem is, again, you are creating a family settlement for which you have to first create a dispute. And when you start giving an idea of creating dispute, that becomes permanent. Instead of property, problem will come up. Whether we should suggest this is something which we have to see. Anticipating a future problem we are settling, we can make up, but case we have to make it up, sir. Again, ingenious minds of the professional. Whether assessee wants that, we have to see. Yes, whether you want all that, you have to plan. Another, oh, sorry, you are halfway through. Still something to be settled on this? Okay, we'll come to this. Mr. A has got one son and daughter. After his life, brother and sister decided property will be retained by brother, because for sister, father has done already so many things. So property will go to brother. But however, as a token, the brother should give to sister 10 lakh rupees. Right? Now they come and say, sister will relinquish her share in favor of her brother. In turn, he will give 10 lakh. The document as it is, the sister gifts, but gets 10 lakh. So there is not a gift for inadequate consideration. Her share of the guideline value of the property, 40 lakh. What she gets is only, so there is a shortfall of 30. So who is enriched? Brother. He receives gift of 30 lakh or inadequate consideration for which he purchased property. From her, his sister, definition of relative fits in. For a recipient, there is no problem. Similar to 56(2)(10), in 50C, if the transfer takes place between the relative, 50C will not apply, no such provision. So now what happens? When a sister gives away her right and receiving 10 lakh for a property value of 40 lakh towards her share, she is exposed for 50C. 40 lakh is the consideration due, 10 lakh is actual, whichever is higher. So now what will happen? Again, our old school of thought of thinking, this 10 lakh be separate, this relinquishment be separate. In the deed, you will say, without any consideration, she has given gift out of pure love and affection. Quantification is difficult, but still, we will say out of pure love and affection, she has given. On the very same day, you would have given 10 lakhs. Cross gift. Not document itself is not necessary. He has given only 10 lakh rupees check. Now this document will say he has given, she has relinquished in his favor gift. On the very same day, he has transferred 10 lakh rupees. Now again, what we have seen already, both are linked together trouble. Some other time, if the sister and brother are ready to wait for next calendar year, fine. We will have to time it. Otherwise, 50C cannot be avoided in the hands of the one who is relinquishing. This is what under tax law will plan. But there are lawyers who would say, she relinquishes without receiving anything. In the deed, she says out of love and affection. She had one son and daughter. You have one son and daughter. After both of your life, her son and daughter come and say, on intoxication, you got this deed executed. Therefore, your son and daughter will not get a better title. Unless you give something as consideration for relinquishment, your future generation will not get better title. Now you'll say, okay, I'll write 10 lakh. So we are only concerned with income tax law. Now they are concerned with property. For us, 30 lakh into 20%, 6 lakh rupees. For them, the entire property, 1 crore. 6 lakh versus 1 crore. Whether you want to challenge the title of 1 crore property itself, or you would like to pay 6 lakh rupees and get rid of it. If 6 lakh more is to be paid, instead of paying 10 lakh, pay her 16 lakhs. 10 lakh towards her and 6 lakh on her tax. At least your generations will have proper title. So this is something where tax alone should not pay consideration for it. Something more also have to be factored. Otherwise, later on, the next generation will start cursing. Yes, sir. Now, if the intention of the father is such that it should happen, fine. If otherwise partition happens, fine. The partition, father has got 10 lakh. Now, unequal partition, sir, but the money must come from the family. Brother should not give. As if father's money of 10 lakh, father's property of this, they would like to divide. That can be partition. Money comes from brother, that cannot be part of partition. If the other way, it is possible. Even before death. This happens after father's death. So this is what again, our ingenious mind started planning all these things. Whether for paying 6 lakhs tax, whether you would like to do all these things, think about it. Right? We have one Salem case where 30 years later, matter went up to Supreme Court. He said, that lady said, my brother intoxicated my father 30 years back and got this property and released everything back. So if when father was alive, give 10 lakh and make it as a corpus, all that is our ingenious mind. Whether client wants that, great question mark. But again, one straight jacket formula would not be sufficient. Each client is independent island. What we suggest for one client, we will not be able to suggest for other client because chemistries are different. We can have options multiply available, but suggestion should be different. Otherwise, trouble will be more both for professional and the consent recipient. Sir, you said by one, right? At what time? Your time has come. 1:30? Okay. It's a case where one should be very careful. Another principle is tax planning should not be purely based on tax consideration. It's a case where husband and wife made a giant FD. This poor fellow said, my name should be first. That lady said, okay, no problem. In FD name alone, his name came first. Her name came next. But money funded by her father. So therefore, that gentleman said, interest on FD should come to my daughter's account. So, first name, husband, second name, wife, interest on FD gets quarterly credited to daughter's account. She is enjoying the interest. Name alone belonging to this fellow. Bank deduct tax at source in first name. For the entire interest, 10% TDS comes in first name. Who has to offer the income? Husband. He doesn't have money. Interest has gone to wife account. 10% tax is already deducted by bank. 30% has to be paid to Government of India, 10 only deduct. Another 20% he has to fund now. It's a live case where, because of misunderstanding between husband and wife went to her father's home. You can't go and ask tax. Now, every year this fellow receives notice, 20% tax not paid. Now, litigation is going on, family litigation one side going on, income tax litigation is going on the other side. Why the hell he should ask his name to be written first in the FD? He should not have opted for it. When father-in-law gives money, let it be in her name. He said, my name be first. Now, year after year, for balance 20% of the over and above TDS, he is litigating. And there is no divorce. If there is a divorce, at least money has gone to her account. There is no relationship, therefore things will go well. But that is not the case here. Still relationship of marriage continues. Litigation is going on otherwise within the family. So now every year this fellow is in trouble. And the returns are separately filed. Right? Now what option? Go to 37BA. Income considered in other hands. TDS considered in other hands. Put wife's name, PAN, click it. She would not be opting for it. It will not get credited in her account. At least from his account it will go. In her return, income of other person included in total income, it will not be opted. So she will not get credit of TDS. If credit of TDS comes, she has to pay balance 20%. She will not fill up so that credit will not come, income also will not come. At least for him, income will go, TDS also will go. Balance 20% he will not be compelled to pay. Let that not enjoy the 10% and making himself liable for to pay 30%. Additional 20% he need not fund. Sum is very big. 10 crore was FD. That gentleman, that father-in-law, how clever he was. 10 crore he made FD in daughter's name, put son-in-law's name as first. Thereafter quarrel picked up. SB interest should go to daughter's name. Took away the daughter to his home and putting this son-in-law into financial trouble. How? This is master plan. Right? Now, this gentleman got engaged to a girl. Somebody mentioned him. He has got very good wealth. Somebody mentioned him. You put a property in your spouse name. That's not going to save you. Definitely, section 64 would apply. Clubbing provisions. After you give, so long as the relationship of marriage subsists, you give without consideration. Income of that property will come only to you. It will not. He asked to that council, when will it come? In order to have clubbing, two conditions to be satisfied. Relationship of marriage must subsist at the time of making the transfer and at the time of accrual of income. So after making transfer, at the time of accrual of income, if the marriage relationship does not subsist, clubbing fails. But we can't recommend this. After the marriage, you divorce, therefore income does not club. For clubbing reason, divorce is not possible. Yes, sir. There are some people experimenting in, sir. We can't recommend, sir. Bill Gates experimented, GD Naidu experimented. We have live cases, but we can't recommend our client. Then he will not come for that to us, right? Now let's come to the other concept. Before the marriage, if property gifted, after the marriage, income accrues. During the time of transfer, there is no relationship of marriage. During the time of accrual of income only, therefore clubbing fails. And after the betrothal, whether the term of relative definition for property under 56(2), an extended meaning could be applied so that recipient would not be exposed to tax to certain extent. So passive. So he has gifted. So he has gifted the property. Thereafter, after the wedding, she will become the absolute owner. She will continue to get the revenue. Clubbing fails. Again, tax planning should not be for the sake of these things. In yet another case, live case in Coimbatore, that lady, after the property received, cancelled this wedding. To the surprise of the family, she went with her friend. Family was very much interested to have the wedding continued, but to surprise her family, along with her friend, she went away. And this gentleman did not have wedding, also lost his substantial property. Fine, very troublesome. Yet another case, what happened? Similar scenario, that lady after the betrothal function was over, substantial property she received, and she went away with her friend, isolating this fellow. This fellow really got disturbed, and his friend consultants, a friend asked him, who the hell has given you this idea? That my auditor only gave this idea. So therefore he said, go and ask your auditor what happened. He only went along with that lady. And now this tax planning for auditor, not tax planning for assessee. Lesson to be learned, these sort of cases, audit assessee should not consult a bachelor audit. Others, risk is there, we can't avoid it, but at least. I'll take 5 minutes. Beyond that, I'll not retain you from lunch. Every one of which we can continue to discuss, but we have some lesser time. Assessee has a young fellow started doing some business, burnt his finger, some depreciation loss, some business loss. How to pay creditors? Loss represented by creditors. Honest fellow stopped business, went to employment, got salary. From that salary, he started paying creditors. For salary income, you have to pay tax in full. He says, I did not have money to pay tax. From salary income, I'm honestly paying creditor. My previous business creditor I'm paying. I want to be honest. You want me to pay tax on my entire salary. Where do I have money to pay this? How difficult this is. Law originally said, your business loss can be set off against salary income. But there are some people in the country created fake business losses and set off against salary income. Therefore, law got amended in section 71, subsection 2, capital A, introduced to say, business loss cannot be allowed to be set off against salary income. Now, this honest assessee, who is willing to pay his debts by earning salary, has to face the music. Right? Now, in the business which he discontinued, he has also a depreciation loss. The restriction in section 71 to capital A applies only to business loss. At least to the extent of depreciation loss, he can set off against salary income, and he will have that much cash flow to pay his creditor. So now, what law ultimately pushes in order to catch hold of somebody who does something wrong, genuine assessees are landing into trouble. Then, an assessee ran into loss, had some factory building to be sold out, got good money. Now he has got some brought forward losses, some depreciation loss, some business loss. If that is allowed to be set off, there will not be taxable income. This money he can pay in full to the creditors. But now you are selling factory building, a depreciable asset, computing capital gain under short-term capital gain folder. You have brought forward depreciation anyway available for set off, brought forward business loss. Business loss is sitting in business chapter, but unless you have a positive number in business chapter, you will not be eligible to set off. But you are having long-term, short-term capital gain on transfer of depreciable asset. Now what happens? Here we have Nandi Steels Limited, Karnataka High Court judgment to say the asset is business asset, depreciable asset, used for the business. Surplus on sale of it has the character of business income. For the purpose of computing income under 5 heads, you are putting in different baskets. This should be available for set off of brought forward business losses. Unabsorbed depreciation, anyway you are entitled. But business losses should be eligible for set off. This anyway, our friend would take the afternoon session. Only one thing, penalty. 271 AAD has come. Subsection 1 says, an entry is made in the books with a view to evade tax, equivalent amount of the entry made, or and omission to make an entry is omits to make an entry with a view to evade tax, equivalent amount of the amount not so recorded shall be penalty. Other side, who is accommodating for this? Bogus bills for GST claim. The other person who has given the bogus bill. Equivalent amount of penalty for him. But revenue realized if this file goes to the other person, jurisdictional AO, who is going to issue notice, identify facts, satisfy himself, it will take long time. For this case alone, this jurisdictional officer can levy penalty on the other person also. So one transaction, 200% penalty. One. These sort of numbers will never be less than 2 lakh rupees. And identified as cash transaction subsequently. So 2 lakh or above cash transaction, equivalent amount penalty. Then income related penalty, 30% tax, 200% of the 30%. So all that will go to say the assessee ventures not to record something which is not real, 420% will go. In addition to that, 234B. And if the numbers are so sizable, 276 CC. So therefore, after this, assessee has to be educated. Gone are those days where if identified, I'll pay the tax alone. For the use of funds from that day to this day, I'll pay interest. My industry gives me better rate of interest. Government, I have to pay only 1%. So I'll treat this as unsecured loan received from government at 1%. As and when they identify, I'll pay tax along with 1% interest. That idea may not go well in the days to come because law is getting straight tougher. And in case genuine scenarios where appeal or revision possible or waiver can be contemplated. Lastly, demand period, we had 115 BBE getting increased. We thought it is only for demand period. Thereafter, the rate will come down from at 60, 1575 plus 4, 78 will come back to 30. But it did not happen. It continues to remain so. And we have this 269 ST. Also, we have 271 AAD. Closing the option of settlement commission, where one time you will not be able to get out of it. Exchange of information with other regulatory authorities. From GST to income tax, from mutual fund, all other state registration department, exchange of information from other revenue and other authorities, collection of information from third parties, all that will strengthen the departmental hands. And more so, the faceless regime. All will go to say, the assessee is making things in order, it will be good. Otherwise, the cost which he has to pay and the cost of appeal, manifold. And in a faceless mode, trying to convince other person without even knowing who he is. That's the greatest challenge we have in convincing in a faceless mode. Keeping all that, will educate assessee to make things clean so that unnecessary appeal, unnecessary litigation, cost, sleepless nights could be avoided. Thank you one and all for your patient listening. Thanks a lot for the opportunity.
Thank you very much, Ramnath sir, for the engaging presentation. May I now request Panaraj sir to present him with a memento. Requesting Satish sir also to jointly present a memento with Panaraj sir to Ramnath sir.